everybody. Welcome to the ECB for those who are in the room with us today, and welcome to the many others who follow us online. So this is today the joint conference organized by the Commission and the ECB. This is about financial integration. Every other year it's in Brussels, every other year it's here in Frankfurt. So this year, I think we have a relevant topic like financial integration, but perhaps even more relevant than previous years with CMU, Capital Markets Union, as a keyword, a buzzword almost, starting from the idea that financial integration within the EU, within the area, could be, say, a bit better. We'll come back to details on this a bit later today, could be boosted. And therefore, the idea of getting to a single market for investment, savings, and capital is really gained renewed importance over the last few months. There were many statements. I'm sure all of you are aware of these things. The ECB presidential speech at the end of last year. There was a governing council statement. There were EFC, so Ministry of Finance declaration as well. ESMA, the market authorities, also very recently published something about this. Plus, there are prominent people formerly active in the European arena, like Draghi, Letta, Noyer, who've produced reports, lots of suggestions put forward. And of course, there's a timing thing. Following the elections for the European Parliament, there will be soon a new commission and then building up a new program. This is very timely to come up with a suggestion on this, especially at a time where we know that the green and digital transition will require at least $1 trillion every year for some time. So today we have a joint organization between the European Commission and the ECB, and we have a balanced program in some sense. We'll hear the Commissioner and we'll hear the Vice President of the ECB, the board member responsible for financial stability and financial integration topics. So we have two keynote speeches. There would be as well two reports on financial integration to be presented, our own report, which I coordinated jointly with Gilles next to me here. So it's a cooperation between macroprudential, financial stability, and international. And then we will have, of course, the report by the Commission. So both are being released and can be accessed during the conference. We'll have also a special chat discussion with the European Investment Bank, a very important player, growing importance player in funding and providing first support, launching and supporting projects and all that kind. And then we will have also two panels, topics for debate, not to say controversial, but at least I would expect active discussion, lively confrontation of arguments on two topics, which are key for Capital Market Union. One is the consolidation of stock markets, financial center type of discussion within the area. And the second topic is the integration, or I would say, sort of better coordination, or not to say centralization. There's a scale on which you can locate yourself, but looking at supervision beyond what is done in this house, in this building even, with the single supervision for banks. What can be done to come maybe not to that point, but something on the way to it. So this is about the rather busy program for today. So we have a long and hopefully challenging, interesting day ahead of us. Some housekeeping things. There's a Q&A after almost all of the sessions, I think. And then you can use the mic in the room. And then there's also the Mentimeter facility that can be used by those online. But I suspect also if you have it's not yet on the screen, but I think the Mentimeter code could be available to those who are also in the room. But again, for those in the room, it's easier and more direct to use the mic. So on these few words, I will hand over now to the Commissioner for Financial Stability, Financial Services, and guess what? Capital Market Union. So please, Mairead McGuinness, you have the floor.
Morning, everyone. Can I say, Jerome, you have set the scene really well for what I hope will be an exciting conference. Now, normally in the financial system, excitement is not really welcome, but we have work to do around particularly capital markets unions. So I'm hoping for lots of strong engagement, and I hope that my speech will stimulate some of that debate. I'm really happy to be here in Frankfurt. I thought I was getting a warm welcome because we saw lots of excitement in Frankfurt yesterday evening, nothing to do with the financial system, but very happy people going to football matches. Not all of them happy with the result, but that's life. There are winners and there are losers. Can I firstly thank the ECB and indeed my own services in the Commission for organising this really important conference, and a special word of appreciation to ECB Vice President de Guindos for what is a really important event. We're talking about fundamental issues in the financial system, but also how we advance our agenda on sustainability and digitalisation. And as is no surprise to everyone in this room, money will matter in advancing the cause of both. So I want to get down to business straight away and talk about Capital Markets Union and Banking Union. Both are essential and they complement one another. But not just talk about the why we need it, but how we're going to make progress in what appears sometimes to be a very difficult landscape. So on the question of why, it's already addressed. We need money, we need investments. And the estimates vary, but the Commission uses a figure of an additional investment of more than 600 billion euros every single year for the climate transition. And this is about investing in all of the renewables, the technologies, insulation, right down to the very basics that our citizens fully understand and know, but also investing in new clean and green technologies, which, will show the fruits when we get the investment in and the products and the innovations out. But if I look beyond the climate transition, we also need private investment in digital technologies, in innovation, and of course, defence. Public finance will not be enough to meet these massive investment needs. And banks, of course, will play a role, but they don't have the capacity to fill the gap by themselves. Instead, the funding will need mainly to come from capital markets. So we need the Capital Markets Union, better known as CMU in the industry, so I may use CMU in the rest of my contribution. And this is a really big project for the European Union. When I was a member of the European Parliament, of course, it was discussed, not advanced hugely, but we make some incremental progress. It's a project that has direct benefit for citizens because it answers the question that they ask: how are we going to fund the climate and digital transformation? It also addresses the political question of how do we have a transition that leaves no one behind. And therefore, the link between people and this project is key. The truth, though, is that we've just come out of a European election campaign in 27 member states where I didn't hear the words CMU and I didn't hear Capital Markets Union much discussed. And it's extraordinary. I've fought 4 European Parliament elections since 2004. I was never asked about how is progress on Banking Union and Capital Markets Union. However, I have been asked frequently why, as a citizen, I can't borrow in another member state. So I think we need to use the opportunity to speak to citizens because they will drive change more than it being led just from the top. So in a way, the campaign for the European Parliament was a missed opportunity. And I hope and I will be imploring the incoming Parliament to get fully behind our efforts to make progress on Capital Markets Union, because citizens do know that there are barriers when it comes to accessing financial products in the single market. And therefore, we need to address this concern because fragmentation leads to inefficiency, missed opportunity, and it is a barrier to maximising the benefits of a single market for capital, which frankly is one of the 4 freedoms that has yet to be fully in place in the European Union. So here we have a lot of work to do, but there's also opportunities when we get the work done. If I look to banking union, it helps to make sure that account holders know money is protected the same way across member states. And banking union is not only there to protect taxpayers and depositors' money, but also to create a single market for banks to the benefit again of businesses, citizens, and the banks themselves. Because a true banking union will lead to more competition, more affordable financing for companies and households, and better financial services. And meanwhile, Capital Markets Union would provide an opportunity to put savings to good use, no matter where you are in the European Union. And this provides better returns over the long term, helping our citizens prepare for many things, including for retirement. And the amount of savings, because Europeans are great savers, it's quite extraordinary the amount of money that rests peacefully, but not actively, in savings, in deposits. We're talking about 33 trillion euros, not an insignificant sum, but perhaps hard to conceptualize because it is so significant. And I think if we can effectively mobilize these savings on our capital markets, we can unlock a significant source of investment capital. And this is key. I want to emphasize, of course, that we're not starting from scratch. There are colleagues in this room from the Commission who've been working on Capital Markets Union long before I've been engaged in it, and you'll hear from them later. You can see from the Commission's European Financial Stability and Integration Review what's being done, because that will be presented this morning, highlighting that the EU is largely self-reliant in terms of many key financial services. So we do have a very solid base on which to build. And this is good news for our open strategic autonomy agenda. But there is a but here, because our capital markets are still not developed enough to meet our vast financing needs. And what we need in the European Union is a deep, liquid, and unified capital market. We need a single market for capital rather than a collection of small and fragmented capital markets. And I mean, there is a third point. The Banking Union and the Capital Markets Union are projects that reinforce each other. CMU requires strong banks that can operate across the single market, especially for services like listing and trading. A genuine CMU would also enable banks to scale up their activities and services. And finally, maybe on the why, there is a huge cost if we do not act. And I here look at figures from New Financial, a think tank. Their estimation is that another 4,400 companies in the EU could raise an extra 470 billion euros every year on capital markets if we get there. And that's an additional 12 trillion euros in long-term capital, which could be put to work in the EU economy to help boost sustainable growth. And that's money and investment that we are missing at the moment. So sometimes I'm asked to do, impact assessments on various proposals. And I think more and more we should do impact assessments on if we don't act, rather than just on when we do make proposals. And I think those figures spell out the impact of positive engagement with CMU. And I also think it links very well with our strong discussions at the moment around competitiveness of the European Union. So let me move to what we need to do. I've said we've made good progress on this project during this Commission mandate. So the European Single Access Point, this online portal for company financial and sustainability information, is being set up. We've agreed the Listing Act, again here to reduce red tape, making it easier for companies to get listed and stay listed. We're working on setting up the EU consolidated tape for a single view of EU trading data. EU finance ministers unanimously adopted the FASTER directive last month, providing for simpler and quicker processes for withholding tax. So political momentum is certainly with Capital Markets Union. EU leaders in the European Council and finance ministers in the Eurogroup have given their strong backing. We have many contributions to this project: the Letter report, the Neue report, the anticipated report from Mario Draghi. So all of this is really encouraging. Now we just need to translate that support for CMU into support for specific measures that will build it. So it's time for action more than words. And I would say we have picked all the low-hanging fruits. So we now have to reach higher in terms of ambition to tackle those more significant barriers that exist. And we need the full support of EU leaders and ministers to tackle those barriers. And you know, this is a moment where we will need to set aside national vested interests, public or private, in favor of the long-term European goals that will benefit all of us. One of the barriers that's often mentioned are differences in solvency law among member states. And this is a fact today. There are many different insolvency pieces of legislation. So investors in this single market have 27 different sets of insolvency laws to contend with. And we do have a proposal on the table to tackle this, to make those 27 different laws more consistent and efficient. But again, I have to say with significant regret that progress in the negotiations among the member states is slow, despite the urgency of CMU and despite political commitments to the project. Another example, our retail investment strategy proposal was very specific in its objectives, to make it easier for small-scale, everyday investors to participate on capital markets. But again, progress is slow. And our ambition in the Commission, my ambition, was significantly watered down by both the Parliament and Member States. And this means that we don't tackle as many of the barriers to retail investment as we know exist and hinder retail investors. So now we're looking ahead to the next mandate with the new European Parliament just elected, to be followed soon by the new European Commission. There are clear indications of what issues the new Commission will need to tackle. Let me say very clearly that nibbling at the edge of this problem will not give us the results that we need. So we do need to hear and see that the words are matched by strong action amongst member states and the Parliament. Because if we don't do that, we do risk not getting the full benefits of Capital Markets Union. So a number of topics are on our agenda. So I'll start with securitization. The Commission is looking and analysing at how to revive the EU securitization market to make it more attractive for issuers and investors. And I can confirm that we will launch a public consultation in the autumn so we can act as soon as possible to scale up the EU securitization market. And the advantages of securitization are clear. It frees up bank balance sheets, allowing for additional investments, which could reach substantial amounts. It also provides an additional asset for banks to invest in. Next to pan-EU savings products. We should explore this to ensure that EU citizens can save for their future effectively. And I think there are positive lessons we can take from auto-enrollment for private or occupational pensions, both inside and outside the European Union. I think there's also lessons, maybe less positive, that we can take from the pan-European personal pension, which has underperformed. The PEP suffered from a low cap on costs and from the diversity of tax treatment across the EU, including a lack of tax incentives. And we will need to consider factors like taxation, product portability, investment horizons, and asset allocation. And now to a third point already alluded to, supervision, which is a critical area for discussion and is a difficult political issue. But for me, as I look at this landscape, it's very difficult to see a genuine single market for capital with 27 or indeed more national supervisors. So a company operating in several member states may have to deal with several different regulators, which may each have different interpretations. Fragmented national supervision will do nothing to address our need to boost EU competitiveness and cut red tape. And fragmentation is not an efficient way to do business. Now, I also want to be very clear that, of course, single supervision cannot happen overnight, but it does need to happen over time, and perhaps not too lengthy a period. But I should also say that we should not make it the only focus of Capital Markets Union or allow it to be the only visible impediment to it, which I am concerned about in some of the conversations that I hear. I just would say that later on today, and very happily while in Frankfurt, I'm visiting EIOPA. And I think that's a reminder not to forget that central supervision is not just about capital markets and ESMA. We should also look to other areas, including the insurance industry. But in any case, we need to have the discussion on supervision now, which is why this afternoon's panel is so important. There are different approaches we could consider, and I'll give you an example. We could start with groups or market infrastructures that provide services across the whole of the single market. ESMA and EIOPA should be able to make the supervisory system more effective and efficient, and this could be through an opt-in regime or joint supervision. A word then on market consolidation, because again, this is another priority and a topic that will be discussed in the panel today. ECB President Lagarde made an important point in her speech on CMU late last year. Instead of waiting for fragmented markets to integrate by themselves, Europe should actively anchor the Capital Markets Union around a unifying project. I mean, does it really make sense to have numerous trading venues with very few or even no initial public offerings? Because that's a sign those venues are not really delivering as a source of new financing. And in the same way, does it make sense to have some 20 central security depositories when the US has only one? Again, member states should set aside national symbols and recognize that consolidation is crucial over the long term to develop a single market for capital. The Commission has launched a study on the consolidation of investment funds, trading and post-market infrastructures. We should think single market, embracing Capital Markets Union as a European project that has enormous benefits for all of us. So I've talked about capital market funding, but I want to just emphasize that banks will continue to play a very important role for the EU economy. We do have a strong banking sector in the European Union, robust capital positions and sufficient liquidity, and that is down to the reforms we carried out, including banking union, single supervision by the ECB, and this ensures that banks in the 21 participating member states are subject to very high consistent standards of supervision. And this is underpinned by a single rulebook, following a long process of reforms to safeguard against any future crisis. The final element of this process is our banking package, which implements the final elements of the international Basel standards. Completing the Basel III post-financial crisis reforms is a major achievement, and it's important that we stick to the date of implementation we committed to, 1st of January 2025. It is in the EU's interest to implement Basel standards. Banks are competitive only when they are resilient and well supervised. And I think we all know in this room, and indeed in the wider world, the price we all pay when banks go into crisis. At the same time as with any international agreement, it's essential that all parties implement faithfully. And this is important for the credibility of international standard-setting bodies. And this is what we did in the European Union. And we are monitoring implementation in the rest of the world. The only area where the European Commission is empowered to delay the entry into application of standards is market risk, if the level playing field cannot be ensured. And this is the so-called fundamental review of the trading book, or FRTB. Rules on market risk are very important for investment banks, and there is strong competition between European, internationally active banks and other global banks. I think by now it's become clear that there will be a delay in the United States in implementing Basel. In practice, the entry of application of the Basel standards in the US is now highly unlikely to take place before January the 1st, 2026 at the earliest. And this is why we have decided to use the Commission empowerment to postpone the date of application of the rules on market risk in the EU by 1 year until January the 1st, 2026. This 1-year delay ensures a global level playing field for those big European banks competing with other global players. It gives us time to see what others are doing. We will work closely with the new European Parliament and Council in this process. We will adopt this delay by way of a delegated act. And this, of course, is subject to scrutiny by member states and Parliament. And this will take a minimum of 3 months. So as you know, our procedures do not allow us to take decisions on postponement at the very last moment. We will adopt this delegated act as soon as possible, again, working with the newly elected European Parliament. But I think it's really important that we give clarity now to our banks. I would also add that we sincerely hope that the US will apply the Basel III standards at the earliest opportunity. And the delay of 1 year of the market risk rules in the EU should not be considered an encouragement to depart from this international agreement. In the EU, we are firmly adhering to our date of January the 1st, 2025 for entry into application of the bulk of the Basel standards. But on market risk, we do need to ensure a global level playing field and alignment on the entry into application of the rules. And as you know, given the length of the procedures to postpone these in the EU, we could not wait any longer. Let me look then to the future about banking union. The Eurogroup agreed to strengthen the common framework for bank crisis management and national deposit guarantee schemes, and that this reform should make sure that more small and medium-sized banks are included in resolution. Member states should agree their position on this framework today. Now, progress is welcome, but as there are a few buts in my speech today, but I have to say very clearly, I regret that the Council's general approach departs significantly from the Commission proposal. Another essential component is also still missing, the European Deposit Insurance Scheme, EDIS. I hope that progress on crisis management can lead to progress also on EDIS. And here I welcome that the Econ Committee of the Parliament managed to vote on its report ahead of the elections. After 9 years of stalemate, it is encouraging to see progress. Moving to a topic which is already a major issue, and that is around digitalization. So a modern integrated financial system is also increasingly a digital financial system. And we've done a lot of work during this Commission mandate to embrace innovation, but also addressing any risks that can arise from new technologies, including artificial intelligence, which has already been embraced by the financial sector. Bankers, insurers, investment managers already using AI to make forecasts, to automate processes, to reduce costs and increase efficiency. AI systems can analyze data from a wide range of sources, market trends, economic indicators, and of course, consumer behavior. And this could help financial institutions make more informed decisions using lots of information. But of course, again, there are risks with AI in finance. Like leaving a decision to a non-transparent algorithm on whether someone can get a loan or not. Now, we have the European Union's new AI Act, together with existing financial sector rules. And this provides a very solid basis to allow for technological innovation while managing the risks. It is now important that the authorities in charge work closely together and with the market to implement these rules in a coherent and sensible manner. And it's important for the Commission, including the AI Office, to work closely together with the European supervisory authorities and national authorities. To inform all of this really important work and understand what the market needs, today we are launching a stakeholder consultation. And I know many of you will be interested in this, and I would invite you to consult the website of DG FISMA and participate in this consultation. So briefly, a few closing remarks in relation to this topic high on our priority, Capital Markets Union and of course, Banking Union. We have had really important political declarations. And of course, these declarations do set the scene. They are vital, but they're not enough. They have to be matched now by actions. Member states need to set aside the short-term national interest and think European. The costs of inaction here are enormous. Not acting means failing to finance the climate transition, failing to invest in digitalization and innovation, failing those startups and scale-ups and unicorns who need investment, failing to drive economic growth and job creation. Now, I do believe that EU leaders, ministers and MEPs recognize the cost of inaction, but they now need to act collectively. And they need to think single market, think European, instead of thinking about borders, about national concerns. it's not in the script, but I never use the words cross-border, except when I'm explaining why I don't use the words cross-border, because I think even the use of those words really impact the mindset. Let's talk single market. Let's avoid the CB word, because that is what is impeding progress around financial infrastructure and integration. And just to say that the Commission is preparing the way, but Member States and the European Parliament have an opportunity to act now and with urgency, with the files on insolvency and the retail investment strategy. And I hope they'll take that opportunity. I will use the opportunity of my remaining few months in this mandate to speak loudly and clearly on this topic. I have watched and listened to this debate, and I am now energized, because my time is short, to make sure that others also agree and act. Because the European Union speaks of open strategic autonomy, of building resilience, of addressing vulnerabilities, of investing in a more sustainable and digital future. You can't do that without money. We won't do it without Capital Markets Union and Banking Union. Thank you.
Thank you very much, Commissioner McGuinness. We have time for questions. Thank you again for your speech. I think it was a very comprehensive review on the state of play on Capital Markets Union. It was also full of stimulating messages on what we should do, and also you designed a very clear roadmap on what the new Commission and new legislators should do. So we have time for questions. We start with questions in the room. One of our colleagues will circulate among the rows and you can ask a question. Otherwise, we have the Mentimeter. I see a question here.
Thank you. Martin Sandberg from the Financial Times. Thanks, Commissioner. The letter report mentioned as an option a 28th regime on insolvency law. That's not something you mentioned, and as far as I'm aware, it's not the Commission's approach. What do you think of it?
On that one, I think we can talk to you after this, Martin, if that's okay, on that particular point, because it's quite a specific one. So I'd rather take some general questions, but happy to address that after. Thank you. I hope you were listening to me, because stunned silence in the room. Maybe we'll go back to Martin's question. Sorry.
Thank you very much. I am myself a proponent of financial integration. However, what do you say to those people that they voice concern because national exchanges and national economies have a symbiotic relationship, and we're not the United States of Europe? So if due to financial integration, big infrastructure or exchanges cream scheme local national exchanges, what is the impact for national economies? What will be the role of national exchanges in financial integration area? And I'm talking from example from the perspective of a small country like Greece with a very local economy. What will happen to Greek companies that want to get listed? What will happen to Greek exchange in an integrated financial market?
Okay, I think we need to think differently. I think today what's happening is exactly to your point of the question, that everybody's saying, what about Greece? What about, whatever, what member states? But that merely means embedding the status quo. And the problem is that Greek companies, startups we do lots of great startups in Europe, but they go elsewhere. They go to the US to scale up. So I would put it the other way. What would happen if we continue to look inwards in each member state? So we have 27 internal thoughts on this topic. And what will happen is we will go backwards. Because in one sense, the last 5 years, we've had enormous crisis to deal with. But the one thing we have learned is that we need to strengthen our resilience. And we do have a big plan around sustainability and digitalization, but we haven't quite told citizens where the money will come from, which also then leads citizens to begin to question the direction of travel. So that's the first point. I think that the second point is, and I think it's fair to say that, of course, this requires consultation and listening to those member states who are concerned. We need to build more trust, I think, within the single market between member states. And we need to rather see the advancement of integration, not as a winner-loser, but as a win-win. And of course, that's difficult if you're looking inwards to your own infrastructure and wanting to preserve it. But preservation isn't growth. And we have seen across the European Union where there are issues around infrastructure that isn't delivering. So I think it's a question of a new start. So we have a new European Parliament. They're already busy working through the politics and committees, etc. We will have a new Commission take over towards the autumn of this year. And I think we know what the challenges are. They're big. And I think we also know that in order to address them, we need that big bang of finance and investment. And we need to think investment versus cost. But again, I do think that, you know, around the table of finance ministers, because we've had these conversations, I can hear those member states who have a little bit of anxiety that they will lose and others will gain. And I think we need to allow that conversation to be heard, and also that we in the Commission very specifically address that is not our objective as a Commission. We want to lift all boats, but we want really to have a single market for capital. We've had a single market for 30 years. It really doesn't exist effectively for capital. And I think it needs to happen, and it needs to happen now. And I always think at the start of a mandate, certainly the Commission is very determined. I'm going to leave a little note for whoever succeeds me to say very clearly where we are at, where I think the issues are. And I think they're more around that dynamic of some member states anxious. They know we need it, but there's an anxiety there. And also maybe those who are less anxious should try to allay the fears of their neighbours as to what the overall objective is.
Thank you very much. Rafael Plata from the European Association of Clearinghouses. Thanks a lot for your words, Commissioner. It was interesting, very interesting the way you put it when you said that you have addressed the low-hanging fruits of the Capital Markets Union. I'd say that probably all of us, in the corridors of Brussels would probably say, could agree with that. So now it's really reconforting to think that the EU is really trying to achieve perhaps the not so low-hanging fruit, and the most difficult ones probably. One of the difficult ones could be taxation. In taxation, you refer to that, and we see different systems of taxation, different incentives for savers, for pensioners, and we see some very good examples in some parts of the EU. What role do you think the European Commission can actually play in trying to either simplify taxation structures or try to use taxation as an incentive for a better use of capital? Thank you.
Well, I mean, we all know that usually member states learn from one another. And I think in this process, the finance ministers are already exchanging what they do to the benefit of all. I mean, in my role, I don't deal with taxation, but I very much welcome the agreement on the recent proposal. Because I think anything that is a barrier to what we're trying to achieve has got to be addressed. But also, anything that can be an incentive to what we're trying to achieve should be looked at. And you know, savers react to incentives. I mentioned the stickiness of savings, and I suppose that's because we don't have a retail investment culture. I become really aware of this when because I was a member of Parliament for a long time, and you realize that amongst our citizens, even financial literacy skills are quite low. We've identified that in studies. So there's also a gap there between industry to some extent and the citizen. And I would also say the industry needs to look at this. They need to look at their own behaviours and practices in order to unlock the potential of that. So what is actually happening at the moment is we're listening very carefully we're at what member states are doing, with the idea that we exchange best practice. And I dare say that whoever is responsible on the tax side will look at this in conjunction with the work that we do, because going back to the very core, you remove barriers and you provide the incentives. It's two sides of the one coin, and I think both are really important.
So maybe one last question from the floor, and then I have one question from the Mentimeter to give a chance to people online to also ask questions. So please.
Thank you very much. My name is Willem Sprenkelen from the Association of Proprietary Traders. I would like to hear your view on the role of investment firms in the Capital Markets Union, because I think we all have acknowledged that we are quite dependent on banks and bank financing in the EU. And you've talked about banking package, banking rules, banking competition between the US and the EU, but I haven't heard you mentioning investment firms once. So what's your role of your view on the role of investment firms in the CMU project?
Seeing as you have the microphone, what's your thoughts?
I think investment firms find it difficult at the moment to basically compete with banks, and I think they can provide nice competition on the level of brokerage, asset management, trading, but they struggle to compete with the banks at the moment. And I think the entry barriers for investment firms are quite high at the moment. So I think it would be wise to strengthen the role of investment firms in the Capital Markets Union.
I think we should just take note of that, because I mean these are part of the whole work around a single market for capital. It's to the very point of the previous question. If there are barriers that make it really difficult, that are not necessary, and that can be gotten rid of without causing any problems around financial stability, then we have to look at the entire package. I think what's extraordinary, if I look out from a wider lens, when the conversation Jean-Claude Juncker on Capital Markets Union began, I think there was more hope that we would advance it more rapidly. And my own view is that we didn't democratize it. We didn't make it an issue that citizens are engaged in and active in. We kept it separate to the financial system, the financial world. I think that needs to change, and I believe that it is beginning to change. And it's beginning to change because the financial world and the political world are now in sync here, insofar as we have made big commitments around sustainability and digitalization, which require investment. That can only come from the financial system, but not as it's structured today. And therefore, we have to look at all the barriers, including the ones you have alluded to, both in your question and your comment, as well as all of the incentives that may be needed to drive the investment culture.
Thank you, Commissioner. So if you don't mind, one question from the Mentimeter, which I find interesting. I read it to you. Why to put so much emphasis on securitizations if covered bonds markets in the EU are much bigger?
I think just on the securitization, I think because there is a need to reawaken the securitization market because it has benefits, as I mentioned in my speech. I also would note, though, that even at my own hearing, there are still some anxieties among some in the political world around securitization, which we need to address, and that's why we're having the consultation, so that we can look at where is the market today, what is its potential, and how do we actually get there. So I take the second point of that question, but I don't think it takes from our focus on securitization, because I think this will only, our objective will only achieve by using all of the elements that are available within the EU financial infrastructure and architecture, and then changing and amending them in a way which loosens up capital in the single market. And this is why I think we need to look at every single possible option. That's the work that this Commission has been and is continue to engage in, so that there will be progress, including on securitization and other topics in the mandate of the next Commission and Parliament. And as one colleague mentioned in the question, the low-hanging fruit wasn't that easy to pick. Even though we were standing on a box and putting our arm up, it wasn't the easiest. I mentioned my own, regrets around certain approaches. And therefore, the next steps will be a tougher stretch. But I think they will test the political will of our leaders and our finance ministers. I think we've had very strong reports, the Letta report, the Neuer report. We have indications coming from what the Draghi report will say on competitiveness. And therefore, in one sense, if those who look for excuses, they will find there's fewer of them to say we can't act, or we're afraid to act, or it's not in our interest to act. And I think that should galvanize the political effort that is required to deliver on these big projects. But I'd remind ourselves, it's 30 years since the single market was established. So maybe in year 31 is a good moment to move really well on these topics. I don't say that out of any kind of disrespect to the past, but as a sign that there's huge opportunities here. You know, we actually have a great opportunity to deliver. We have all of the reports, the comments, the endorsements, and they weren't easy to deliver either, frankly, because I was part of some of the discussions. Now we have to move, and the time now is to act.
Thank you very much, Commissioner McGuinness. It was a sort of conclusion. A warm thanks for your presence here, your enlightening speech. Thank you very much. Time for the second part of our conference, where both the ECB first and then the Commission will present their report on financial integration developments in Europe. And we start with Jérôme Henry. And after the two presentations, not in between, but at the end of the two presentations, we will have time for Q&A. So Jérôme, the floor is yours.
Thanks, Gilles. And hello again, everybody. I'm happy to give you now an overview of our ECB financial integration and structural report about what's happening in these fields in the area. It's joint work with many ECB colleagues from many business areas. I think we had to cut across markets, and sorry, we had to cut across borders inside the institutions as well. So international research, statisticians, you have a statistical annex which has been pre-released, which is backing most of the things I will present. But we have also people from market operation, and financial stability, payment system, whatever you. All right, so I would say slightly contrary to the report itself, which has a very strong focus on policy steps, echoing very much what we've just heard. You will have another service of this with our Vice President a bit later today. Here, I will focus really on the ethical part, which is like the second part of the report. And I will do that in three steps in a way, or three ways. I will first talk about the context in which this report has been produced. It's only every 2 years that we produce the report at the ECB. So things have changed somewhat over the last 2 years. On the macroeconomic and financial side, relatively obviously, so setting the stage in a way. Then I will talk about the financial structure, the financial integration based on the indicators that colleagues in statistics and research have developed. And then as we go along, I will mention some of the boxes because we have deep dives in the report on certain topics where we give more details and provide more analysis. I will remain relatively high level, not that technical, but that's a bit of a teaser for some of the deep dives that we have in the report. So first, let me talk about the background with respect to 2 years ago. Remember, in 2022, we were just coming after two so-called like secular shocks, one after the other within 2 years, with the pandemics and war in Europe, which had huge consequences on the macro and also the financial aspects. And this is really, maybe if you look at the right-hand side chart here, which shows in blue the inflation rate with 2-digit being passed, as you may recall, and then the yellow line, which is the ECB policy rate, the key policy rate, with at the end, on the far right-hand side, the yellow line going up and up and up, the sequence of hikes, which has been the case until very recently. Why did we see this? Because we had huge shocks on commodity prices, in particular oil prices, that we see on the left-hand side, on the blue line. And then this is still something that we see now, pressure on commodity prices has not evaporated fully, and there may be further hikes down the road. And then you have the yellow line there, which is the new risk in a way, or prevailing risk, like in our financial stability review, where we have a special part on these aspects. To which extent geopolitical risks? Here, this is the Iacovello et al. Indicator, which is basically like showing war, conflict type of indicator. So we see at the very end of the sample some sort of hikes in this geopolitical index. We are very far from the 9/11 or the Gulf Wars type of thing, but still, this is going up, and this is seen as a major risk for trade, for asset prices, and that's where financial integration does matter a lot in such a tense environment on the macro side, because inflation and high interest rates, and because of geopolitical tensions, trade restrictions, what have you, we need a resilient system. And this is in this context that we have also the strategic autonomy type of thing, which for the EU is really important. This is very much related to policy objectives that I will finish the presentation with, focusing, of course, on capital market union. Oops. Yeah, some status fact on the structure. On the left-hand side, you see the volumes for banks, non-banks, and the ECB asset size. Of course, they are the sort of exit from the policy steps taken right after the great financial crisis during the euro area debt crisis as an effect, namely the balance sheet of the ECB and the assets held, therefore, in the financial system are declining. Otherwise, we've got a decline as well for the blue, which is the banks, and the red, which is the non-bank and BFI institutions, but this is mostly a valuation effect. So this is really because the pricing of the assets has declined somewhat. What we see on the right-hand side are the volume translated in shares. In green, we have the ratio of NBFI with respect to banks. And there it's interesting to see that after the increase of about almost 2 decades, there's been some decline or rough stabilization over the last 2 years of the market share, if you like, of the NBFI vis-à-vis the standard banks. So a bit of an interruption in the trend there. Otherwise, outside the euro system sort of stabilization and initiated decline, there's a rather stable picture in terms of the structure. If we focus on BFIs, so zooming in onto these subsectors, so to say, on the left-hand side, we see that the recent moves up and down were driven by investment firms. And that's also related to moves in the insurance. And so that's the green, blue parts in the bars that you see on the left-hand side. So investment funds, insurers, pension funds have really driven the changes in the NBFIs sector recently. On the right-hand side, there you see the split in terms of the total amount, which is the red line of investment funds assets. They remain mostly outside the euro area. There's been a stabilization, that's the yellow part, even a sort of slight increase over the recent 2 years of the euro area holdings, but it's still lots of activity outside the euro area for these funds. All right, turning now to our integration indicators, which are basically, in a nutshell, indices based on dispersion and volatility across countries and across financial products. And we compute these kind of indicators both for prices, say stock prices, bond prices, or quantities like holdings of deposits or holding of debt securities across countries. So the blue line is the price-based indicator, the yellow line is the quantity-based indicator, and then focusing first on the price-based indicator, you see that we have, despite the pandemic, despite the Russian invasion of Ukraine, the latest event on the right-hand side of the chart, we see some resilience of the indicator, which is like the positive part of it. Having said that, I think the key messages are elsewhere. Namely, recently, over the last 2 years or so, there's been a decline in these indicators. Both the blue and the yellow line are lower when they were, say, in the beginning of the 2020. And then, second key message there as well, Well, if you look at the dotted line, blue and yellow, this is the starting point when monetary union started. And what we see there is that we're not doing better. So there has been no marked progress, but there's been resilience. But the fact that there's no marked progress is sort of worrisome. So in this report, we also have, as I said, some deep dives. We have no less than 8 boxes on key topics with respect to financial integration. And we have in particular paid specific attention to Ireland, Luxembourg, Netherlands, not just to name countries, but that's because these are the location of the main vehicles for investment by other countries. So as a vehicle, as an agent there. What is the conclusion of or what are the main conclusion of the analysis presented in the box? First, many investors use those countries or the funds located in country to invest outside the euro area. But conversely, also investors from outside the euro area reinvest in the euro area via these channels. The caveat on this is that, as a matter of fact, many investors in a given country would go via funds located in Ireland, Luxembourg, Netherlands to invest back in their own country. So in a way, that's biasing the indicators, and that's the kind of things we can see on the chart there, which is showing home bias. So to translate, this is the share of domestic share or equity or bonds that are held by people. And when you want to have diversification at the country level, you would expect the home bias to be lower. Once you correct from the indirect holding of own securities via the funds located in Ireland, Luxembourg, and Netherlands, what you see in particular for equity, this is the left-hand side, is that the equity home bias is higher on the yellow line than it is on the blue line. So that the broad number are the blue line and the yellow line, then we go to something very similar to the US. This is true for equity. Going indirectly owning your equity, own market equities via the funds located elsewhere in the euro area. This is much less true for bonds. So as a result, we see once we do this kind of adjustment that the euro area is less integrated with the rest of the world, but also less integrated within the euro area. A closer look at integration for bonds, where we've seen the correction was not so much impacted by the financial center correction that we did. We have a stabilization. And then what we see in the left-hand side, that's the quantity indicators, just following the blue line there. Intra-area bond holdings has been going up and down, but is increasing over the medium term. Another thing quite important is the red line, which shows the ratio between long-term to short-term debt instruments. And then there's a sort of rebound towards long-term lending with respect to what we had beforehand. The other chart is the blue on the right-hand side is the price indicator. We see lots of ups and downs. That's volatility on the bond market. But what's interesting there is that despite all of the turbulences we've seen in financial markets, including in some banking sectors, as you know, I think we're not in that bad a situation. But still, if you look at the indicator before the great financial crisis, we're still a bit lower. But I would say, taking into account the fundamentals that could drive the prices for bonds, I think this is not probably the main problem area. We also have okay, sorry for this, some problem with the pointer here. We also look at the integration for bonds in sense of looking at the role of EU bonds. So this is the new generation EU, the support for unemployment in emergencies, or the green bonds in particular. So we look at who holds them. And what we see on the chart there, we have the banks, which is the biggest bar. And it's there quite interesting for the other sectors, insurers, investment funds, pension funds, as we go from left to right. From a country perspective, we see the big 5 countries for the banks, But then we have some specialization. For the insurers, the French have the lion's share. For investment fund, it's Luxembourg, and for pension fund, it's Netherlands. So it's reflecting the specialization, if you like. What we could see there as room for improvement is that both the volume of the funding that is dedicated to green bonds could be increased, and also there could be, let's say, some improvement even from a purely technical perspective, so that the risk premium for such bonds would come closer to those of large sovereign. And it's not a rating issue, actually. It's more a liquidity, free float, the type of issue, that transaction cost not included in futures or whatever you, which prevent those bonds to be really as good from a market and pricing perspective as the large sovereign. So we look also at activities of banks cross-border, my God, by sectors, and what we see there is that the lending, due to interbank lending that has resumed across the borders of the Union, has increased. But at the same time, it's really more sort of bank level. On the retail type of thing, it's a bit of a different picture. If you look at the price index, which is again the blue line on the right, we see a decline, and this is related to a very specific thing. It can be identified why we have this decline, albeit from a higher level. So it's not as good as the picture for bonds. It's really because of deposit pricing, where we know there are lots of country-specific, banking sector-specific approaches across the euro area, and this is why we see this decline here. Equity market, last but not least, on the product, we see stable shares. This is the right-hand side, the left-hand side, sorry, the bars. We see very stable share between domestic, across borders, and across border, but coming from outside the euro area. So there's the volume is changing, the size of the bar, but the various configuration, the structure, if you like, is not very different. Let me say a few words on the right-hand side chart, which is about the foreign direct investment with respect to portfolio investment. Two things on this. There had been, if you look at the ratio there, which is the red line, foreign direct investment deemed superior because of long-term, more productive than portfolio investment. We had in the most recent crisis a drop in this, and there's been a recovery. However, over the recent period, there's still a sort of not so strong share of FDI in investment from the external side in the euro area. This was about listed shares, by the way, what I presented on equity, and we have also a box about listing or even delisting. The interesting conclusion there is that we don't see in the data a sort of, I would say, unusual development in delisting or unlisting shares with respect to historical events, because you have M&As, you have firms that disappear, and what we've seen recently, there's no like acceleration or deep change in that. At the same time, when we compare with the US, and this is about the chart that are there on the screen, if you look at the right-hand side in particular, we see market capitalization of EU countries, US listed only, dual firms is the blue line. We see a sort of explosion in the capitalization and the share of so-called dual firms, that is to say firms that decide to be listed in the area, but also in the US. And why do they also go in the US? As long as they don't go only to the US, well, they can get capital there, and that may help also on our side eventually. But the reasons we identified were depths of the market, and very much related to points that were mentioned by the commissioners beforehand. It's simpler type of thing because you have one regime and not the same complexity. It's easier from a regulation perspective, and you have also a deeper market as opposed to a more shallow one, especially if you look at financial markets that are still financial centers. fragmented and segmented within the euro area. All right, before finalizing the presentation with a quick overview of or linking to the policy steps, let's say we have 3 areas of interest that we have identified. First, mobilizing the savings, also echoing what was said before, in particular household savings that can be used. There's lots of deposits. This is the far left-hand side chart. Lots of deposits, insurers, pension funds. Household savings could be better used for more innovation and productive purposes. There's a second area, which is harmonization and regulation. So harmonizing, perhaps up to centralizing in some cases, and also working on simplifying or adjusting, fine-tuning regulations. Third, facilitating cross-border operations. Sorry for the terms. And then I think 2 of the cross-border can be, once again, within the euro area or from the outside, inside the euro area, as I said earlier. So these are the 2 other charts. In the middle, what we see is that there is still a relatively low role of banking type of thing, which is not domestic. So the blue line is the pure domestic, and the other 2 are coming from other countries or coming from outside the euro area. So the shares there are very limited. So there's a need to improve on that, obviously. If you look at the last chart, euro area holdings, extra euro area holdings, in terms of how euro area securities are bought by outsiders, you see there as well, be it for equity, where we have a slightly larger share of extra euro area, for investment funds and debt, it's still relatively limited. So I will stop with this chart at this point, showing 6 priorities that are listed in the report, with a view to improving on the 3 wheels that you see there, namely facilitating operation across borders. Then it has to do with crisis management and cross-border banking in general. There's harmonization and regulation, so it's more at the even conceptual level. There may be definitions that differ for specific products or indicators across EU countries, and then a lot to be done on regulatory and supervisory architecture. Finally, on mobilizing saving, you have standardization and transparency for structured product with a specific focus on securitization that we can revive, as was explained, elaborated upon before. And then a sort of generic overarching type of thing where it's a bit more difficult to identify concrete steps, to be honest, but it has to do with financial literacy as well, and boosting venture capital so that the capital and equity market in the EU could be much more dynamic than it is now. Thank you.
Thank you, Jérôme. So now it's the turn for the Commission to come on the stage. And I'm very happy to welcome Paulina Dejmek-Hack. She's Director for General Affairs at DG FISMA, European Commission. Paulina, we work regularly together on financial integration, so we see you every year with pleasure, actually. So I give you the floor for your presentation, please.
Thank you very much, Gilles, and good morning, ladies and gentlemen. It's great to be here. And first of all, my thanks to the ECB and the team here for hosting the conference, or co-hosting it with us, but on your premises. And thanks also to the teams, both in FISMA and in the ECB, for all the preparations. I know there's been a lot of work going into it. Interesting times, as we always say. I think we are at a very interesting, of course, political juncture. The Commissioner referred to that already. We just came out of the European Parliament elections, a lot to be done on capital markets and banking union in particular. And we will get back to these topics also later in the panels, and having the opportunity, I think, to continue to build on some of the interesting, I think, conclusions and suggestions that have been made already. But before we come to all that, I am going to present to you very briefly our report, the European Financial Stability and Integration Report, FSIR. We like our abbreviations in Brussels, as you know. And the idea would be that I take you through that very briefly. I think it's quite complementary, of course, to the work that's been done here by the ECB colleagues. And I'm hopefully going to not repeat much of what Jérôme has been saying. I think he has been very complete already on the integration side. And we, of course, share very much the ECB's analysis. And by the way, also we, as you mentioned, we work very well together and we rely a lot on the ECB colleagues for our data. So certainly no disagreement on the assessment of the situation. Now, what we try to do in our annual review is to assess, of course, market integration, and Jérôme has spoken to that already, but also in general, the economic development over the year. Inevitably, this is a report which is backward-looking. So what we looked at was 2023 and the first quarter of 2024. And I will, in the following minutes, just give you a few highlights from that report. So that's the, let's say, the main part, the first chapter. And then we always have in the two second parts of the report a little bit of a deep dive on two topics that, of course, are interesting for market integration, but also we try to choose topics that are a little bit topical in the general policy discourse. And the two topics this year have been referred to already by previous speakers. And what we've been looking at is the investment fund sector in the EU, very linked, of course, to the international conversation, and also the BFI question. And by the way, we had a question earlier about the role of investment funds in the capital markets union. I think this is precisely where this topic sits. And then the last topic, the last chapter, is also something that's been referred to already: third country dependencies in the EU financial sector. Open strategic autonomy, economic security, you've heard those expressions already. We have open markets, which is great, and our financial systems are globally interconnected, and that's a good thing. But of course, that can also come with some vulnerabilities, and that's why we need to be a little bit vigilant on this matter. Turning briefly to the general financial situation, and as I said, this is of course a little bit of a backward-looking exercise, but as always, we need to understand the past, or we need to know the past to understand the present and prepare for the future. So if we look at 2023, as you will all remember, a relatively difficult year in terms of economic growth. Economic activity broadly stagnated, obviously also linked to the overall geopolitical tension that continued, the second year of Russia's war of aggression against Ukraine, and that, of course, was weighing on consumer spending, on economic activities, and on everything else. As always, a slightly divergent situation across member states, with a little bit of stagnation here in Germany, but of course a little bit more growth in terms of real GDP growth if we look in Southern Europe, countries like France, Italy, and Spain. In the meanwhile, I think the forecasts are a little bit more positive. As mentioned, the cutoff date for this report was March this year. We had our spring forecast in May, the EU economic forecast, and there we could actually revise upwards a little bit the forecast going forward, predicting that growth will be picking up in this year, but also in 2025. And of course, at the same time, inflation also continuing to decline. Financial markets fluctuating in 2023, as you will remember. Sovereign bond spreads diverged across the member states. Corporate bond spreads narrowed over 2023 and into early 2024, despite rising corporate fund. And you see that, of course, in the graph. Stock markets started positive in 2023, but then, of course, we had the turbulence in the system. In March 2023, the failure of the Silicon Valley Bank in the US and a couple of other US banks, the Credit Suisse situation here in Europe. Now, I think the good news here is that equity markets actually did recover quite quickly. And I think that is also, I think, a proof of the resilience of our banking system here in Europe. Also, obviously, thanks to the regulatory changes we've done over the years, but also the very good work of the colleagues at SSM here in Frankfurt. Moving then to financial stability, risk remained elevated in 2023, as mentioned, due to the various, of course, geopolitical factors in particular. Now, I think also here we probably are in a slightly better situation now, and I think a more upbeat financial market sentiment, where we've been talking about the kind of risk of some rather rapid kind of asset price corrections, but it hasn't actually happened. And I think overall the situation is more upbeat, but obviously, as always, as we like to say, no room for complacency, and we need to remain quite vigilant. In particular, of course, the interest rate environment will impact the debt servicing capacity of economic actors over time. What we can see is that the profitability of non-financial corporations has been quite strong, but obviously the companies that already were a little bit weaker are doing less well. We do see, by the way, also corporate insolvencies going up. That was very expected, also coming out of COVID, where, of course, a lot of companies got public support. Some of them probably were weak already, and you can kind of see now when that kind of public support, all these schemes are being phased out, that we have got some more insolvencies again, probably not unexpected. If we look at the household situation, was over recent year, very low debt servicing costs. Also, we have a strong labor market, a persisting strong labor market, which of course is good news for the household in terms of income coming in and the possibility to service their loans. At the same time, of course, over time, this is becoming a little bit more complicated, especially in those member states where households tend to have variable interest rates, where of course there can become some pressure on households to service their debts. Looking at real estate, which is also, I think, a sector where we have a little bit of a divergent situation depending on what member state you are looking in at. Again, I think more of a complicated situation in some member states than others also, although by and large, I think we have not seen in Europe maybe the challenges that we have seen in the commercial real estate sector in some of our partner jurisdictions. And then finally, looking at the banks, looking at the financial sector, I think there, as always, of course, financial markets do remain very sensitive to the overall geopolitical situations and the various tensions that we see in the market, further interest rates development, and economic growth forecast. I think our banks in Europe, thanks of course also to the interest rate situations, did have good profits last year and the first quarter in this year. And I think it's of course a good thing that our banks are strong, and we will have to see how that develops going forward. Then turning very briefly to the two more, let's say, deep dive chapters in our report, investment fund sector. On the one hand, of course, we see that this is a sector that is growing in terms of assets, and Jerome spoke, I think, very insightfully to that topic. Earlier, we have a very bank-dependent economy, as was mentioned. It's of course a good thing that we also, in the concept of capital markets union, that we have more diversified finance. We see that the funds can play a role in providing support and financing support to the real economy. At the same time, of course, that also comes with potential risks. And as I mentioned already, we have a very active, I think, international conversation around non-bank financial intermediation. We launched ourselves a consultation on this a couple of weeks ago, which will be running until the end of the year, until December. So if you haven't looked at that yet, please do take the time and answer to that consultation. We, of course, want to look at the NBFI sector quite broadly. It's not only investment funds. What we look at in this specific report, though, in the FC was on the investment funds. The risks here, or the potential risks here, well known, of course, liquidity mismatches and leverage, which if a lot of funds get into difficulties at the same time, may be of systemic relevance. Important to have monitoring systems in place that can make sure that we can react, or the funds themselves actually can react in time if you do get these kind of mismatches. And of course, also making sure that the funds have liquidity management tools in place. Now, I think the good news is that in the EU, our investment funds, be it UCITS, be it AFMDs, be it money market funds, they are, of course, all well regulated. And we have done some recent changes that are very important in this context. And that is the latest revision to the AFMD directive and to the UCITS directive that precisely has reinforced the rules around liquidity mismatches, around liquidity management, with the new rule now that the open-ended funds need to have 2 LMTs in place. So these can be things like longer notice periods and redemption gates and these kind of measures. And we have the rule also that money market funds need to have at least 1 additional LMT. So that, I think, should means that we have already taken some quite useful action in this area. Leverage, of course, this is something that can be problematic and needs to be monitored. Now, in general, if we look at our open-ended funds in Europe, they are not particularly leveraged, but there are, of course, some outliers out there. So something that we need to be a little bit vigilant with regard to as well. And then moving briefly to the last chapter, chapter 3, and that is the openness and third country dependencies. As I mentioned earlier, I think it's a good thing that we have an open financial system in Europe, that we have a globally interconnected system, that we have investments coming out from outside Europe. What we tried to do in the report was to look a little bit at different sectors. Clearly, having an open market means that we have more competition, that we have better access to finance, hopefully better access to financial services, and that can stimulate innovation. At the same time, of course, it can also come with some vulnerabilities we've seen in recent years. The challenges we may face when we have a too high dependence on third countries, which goes, by the way, as you know, beyond, of course, the area of financial services. So what we were looking at here in the report was actually looking at a bit segments of the financial services sector. So looking at our dependence on, of course, derivatives, clearing and settlement, credit ratings, retail card payment systems, and some other sectors, including also insurance and reinsurance. And I think our assessment of what we put in the report is that if we look at these sectors where we have a very high dependence on third countries, these are third countries that are part of our G7 partners and allies, where we sit around the same tables. We discuss in the Basel Committee, we discuss in the Financial Stability Board, we see each other in IOSCO. So I think we can probably be quite confident that these are countries that follow the same regulatory frameworks as we do ourselves, but nevertheless, of course, something to be a little bit vigilant for, and I think it's fair to kind of conclude that we will have these dependencies on third countries and their operators in the foreseeable future. Again, that is as such not a problem, but clearly something that we may want to still continue to be paying a little bit of attention to. Also, and I will close on that remark, I think that also brings us back to what the Commissioner was mentioning earlier, and Gilles was referring to it as well, as did Johan, by the way, the policy work we are doing ourselves in terms of building our capital markets union, strengthening our market infrastructures, and increasing access to finance for companies in the European Union. And of course, also by the same token, making sure that we get a higher retail participation in our capital markets. And all that, of course, for the benefit of citizens themselves, but also the transitions that we need to finance. So I think all in all, and I will close on that, do take some time, if you haven't had time yet, to read the report. I think this was a really 5 minutes helicopter summary of our FCIR, but hopefully it gives you a little bit of an idea of what the report is about. And I will leave it at that. Looking forward to being on one of the panels later, where we will talk about cross-border consolidation. Well, cross-border, I said the CB word, although the Commissioner had just abolished it, but consolidation in our trading landscape, and clearly, of course, one issue that we would want to look at in the Capital Market Union context. But I will stop there, and very happy to take a few questions together with Jérôme if I understand well. Thanks for your attention.
Thank you very much, Paulina. So you had the view from the ECB, from the Commission, complementing each other very well. So again, we'll start with questions from the floor, and I will check the Mentimeter for additional questions. So we have two colleagues helping you, bringing a mic to anybody that want to ask a question. Yes.
Good morning, Nuno Amado from Portugal. Two comments. I will ask two comments to Jérôme, or two questions that I will raise. The first is about the CMU and banking unit, about its importance and where we are in both right now. In my views, I'm not an expert on CMU, but we are clearly, we have a long way to go, but on the banking union, we have not a long way to go. We have a banking union we started 10 years ago, as we know, and nobody mentioned, but it's still incomplete. It's not finished, okay? And coming from periphery country, I understood that 10 years ago there was a lot of resistances to complete it. Right now, I don't understand. Really, I think we have the conditions on the banking side, on the supervision side, to complete it, but we didn't. So don't you think this is an indicator that we are not ready yet for a full integration or for a speedy integration? Second comment is on cross-border lending. I came from a bank, so it's easier to focus on that. I understood that cross-border lending is at a low level, but I'm sure that you have some segmentation analysis, and I would guess that on large corporates, the cross-border lending, if you add corporate cross-border lending plus market finance, that share will be large on large corporations. I also understand that for retail and for micro and small business, local is normal, because administrative processes are different, because judicial system are different, because taxes are different. So I understand that is normal, that for the lowest segment, but very critical segment, mortgage, consumer, micros, small corporations, local institutions have a proximity, and that's not negative, that's positive. So I understand that probably where we have a larger problem is on the mid-corps, the ones that want to grow and will not have enough access. Can you comment on this more deep dive analysis, if you have it? Those are my two questions. Thank you.
Thanks very much. Very relevant questions. Well, I must say, personal view, speaking on my behalf here, I think we've worked a lot. I used to work a lot on the preparation of supervision and banking union, even before the SSM existed. So I would agree with you, lots has been done. CMU is a relatively new topic for me, and it's also very challenging because there's a lot to do. So I won't come back to that. We seem to have some convergence, as you heard, between what the ECB is trying to push ahead and what the Commission is envisaging. I think in both cases, I think we have to deal with member states. I mean, this is a union of differing member states, and they have different views, different opinions, sometimes strong views on some of the aspects. So I would also agree then that the banking union is incomplete, but I would certainly disagree with the idea that nobody mentions it. I think there's huge number of ECB communication on this about the fact that banking union is not completed. And I think that's, I won't quote because there's no need for that, I think. Maybe that was a bit of a provocation almost on your side because we're here at the ECB today. But anyway, more seriously, I think the reason why it's deemed incomplete is indeed, like, at least I would say one element is the deposit guarantee scheme. It is, even though there's progress there, and I think it was noted by the commissioner, certainly some progress, but it's not like a complete overview there. And there's also, let's say, crisis and risk management. There's something on this among the policy steps I mentioned, to take very much a group type of approach rather than a collection of nation-specific subsidiaries in some sense, even though we have a single supervisors there for banking, we're not yet there. That relates to cross-border lendings. Indeed, large corporations are doing it because they have the group approach themselves, by the way, very certainly. On the retail front, I agree with you fully. Administrative, regulatory, judicial, taxes differences do not facilitate the kind of these operations. When I happen to talk in banking fora and I talk to people who are looking at consumer lending because they're interested in dealing with credit risk, they also want to have more possibilities to go across border to lend. And they say, so it's not the demand side only, also the supply side, they have problems. And I think there are two remarks on this. I think the risk management group level type of thing inside the banks, so they could do this part of the work themselves or have incentives for doing that. If they have a risk management, we see that at the group level, both for liquidity and capital, that would facilitate, I would say, the other side of the balance sheet on the asset side. And then the other thing, which is a bit like well, the elephant in the room that we don't see, is that we have not seen, I would say, any kind of, I would say, significant consolidation in the banking system, in particular, mergers across borders. Because I think once we have this, even if there's one bank or group of banking starting with this, then I think this would launch probably unavoidably a very strong dynamic in this respect. But we're missing it. I mean, I don't disagree with this.
Sorry. Yes. No, just to add very briefly, I think Jérôme was very comprehensive. I mean, maybe on the local banking element, I guess what we also want to look at, I mean, it's not so much an issue of saying that the local baker who needs a small loan to buy a new oven, more energy efficient, one would hope, that he would necessarily want to get funding from another member state. I think what we are looking at in the context, I mean, it's normal that that guy goes to his local bank and gets his loan. I think what we are more thinking of in the context of Capital Markets Union is the innovative companies, the new clean tech companies, the let's say more risky companies, where it may be more difficult to get the bank loan because there is no kind of history, there is no data to actually show how this company may go in the future. And I think that is probably the segment that we are looking at. And there we think it would be useful if there would be, and I'm not going to say the CB word, but there would be more internal market flows of capital, be it access to venture capital, be it easier listings, be it business angels or what have you. So that on your second point. On your first point, and having followed the CMU debate from the very beginning from 2015 when we launched the project, I think it's a little bit a matter of, is the glass half full or half empty? I think we have done a lot, as the Commissioner said. We often speak about collecting the low-hanging fruits. Now, in fairness, some of these low-hanging fruits were not that easy to collect either, but we have done a lot, when it comes to now the new Listing Act, when it comes to ASAP, as the Commissioner mentioned, some changes to the fund regulation that we mentioned. Some of these rules, by the way, still need to enter into application. So they are agreed by the co-legislators, but we have not yet seen the effect in practice. But then again, there is more to be done, and I think there has been a recognition by the finance ministers and the EU leaders that we need to do more on CMU. Like Jérôme was saying, I think actually that we speak a lot about the CMU, which is probably a good thing. on banking union, and I think that the Commissioner reference to it, it is incomplete indeed. We have SSM, doing a fantastic job here in Frankfurt, Single Resolution Board, well established as well. But obviously the pillar, which would be the European Deposit Insurance Scheme, is missing, and some more progress would be needed there. I'll stop there. Thank you.
Thank you, Paulina. Other questions in the room? No. So I have one question. Actually, after that, we have to go for the coffee break because then Mrs. Calvino is coming at 11. So quickly, one question from the Mentimeter. We hear a lot of discussion on capital markets being an alternative to a bank-dependent system. But what about the fact that investment and commercial banks are main participants in capital markets? So whoever wants to answer, or both actually, as you wish. Paulina, start.
Okay. No, I think this is an important remark, and maybe also a good occasion to be very clear on what we mean. I don't think the idea has ever been to say that, let's abolish the bank and it should all be capital market financing. It's really a matter of expanding the ecosystem. We have a solid banking sector in Europe that clearly plays a big and important role to finance the real economy. Whatever figures you use, 75% bank finance, 25% capital market finance, the US, the opposite, as is always mentioned. And I mean, this is the European model. And I don't think anyone kind of thinks that we will become the US and that we would want to become the US by any stretch of imagination. So I think it's really a matter of expanding that ecosystem, making sure that there are other financing opportunities than banks, which is not replacing banks. It's basically making the pie bigger. And as I mentioned earlier, I think precisely in those segments that maybe are less, let's say, suitable for bank finance. It's clear that our banks play a super important role in the capital markets, and that is precisely what they should be doing. So I think the way we have always seen the Capital Markets Union project is a project with the banks, and that we together basically build these ecosystems. So it's really, really important to be very clear on that this is not at all a kind of either or. It's really everyone together for the benefit of deeper capital markets in Europe and more integrated market and more access to finance for our companies.
Well, just a few words on this, because I obviously agree with what was said by the Commission on the extension of the system and still within the EU model. Maybe 2 points, demand and supply related, which would echo somewhat some of the policy points I made at the end of my presentation without elaborating that much on them. I think the connection to retail or small or more granular demands and supply actors is an important element in the expansion of the system. It's not only to go across border, but the scope of the capital market should be extended. So if I give 2 examples, I would say SMEs, for instance, via securitization, there could be, or other structured products, there could be more access. In particular, I did not insist on that, but I would support, it was the first answer provided by Paulina on innovation and these kind of things. And then for retail investors, for that matter, this is about the risk culture, venture capital, having more at the even household level, more, as we see in some countries actually, in the EU or formerly in the EU, no names given, we see more risk culture. So I think there's the hope that over time, we could also boost this sort of willingness of households to be involved a bit more, either directly or via, for instance, pension funds.
Thank you very much. Thank you, Paulina. Thank you, Jérôme, for these 2 presentations. And thank you for answering the questions. So we have a short break now of about 10-15 minutes before Mrs. Calvino joins us. Thank you very much.
Welcome back, and hello to everyone who's joining online. My name is Martin Sandbu. I'm the Financial Times' European economics commentator, and I'll be conducting this fireside chat with Nadia Calvino, who doesn't need much introduction, and in any case, it would take up the whole 30 minutes to say all the things you've done for the European project. But you are here as the president of the European Investment Bank. I thought, we want to hear quite a lot about what the EIB is setting out to do, but I thought we could start because you have this very broad perspective from the Commission, from the political side, and now, of course, from the EIB. On the very big topics we're actually here to solve. This is a conference about financial integration or the incompleteness of financial integration. But financial integration itself is a means to an end, and the end, as we all know, is to get the investments we need for the big transformations ahead of us. And the problem, I suppose, is that we haven't been investing enough for a long time. We are still not. At the Commission Economic Forecast back in May last month, Commissioner Gentiloni mentioned that we have still, even though we have strong-ish public investment on the back of the recovery fund, we still have sluggish private investment. So I thought I would start by just asking you, what is the core of the problem here? Why have we in Europe been investing too little for too long? What are the main obstacles to investing enough?
Well, thank you very much for the invitation, and it's a pleasure to participate in this event. I mean, everybody agrees that there is an investment gap, that Europe needs to invest more. There is also, I think, a quite broad agreement that it is the private sector that is especially lagging behind when it comes to R&D and other investments that are bringing innovation, productivity gains, etc., in other parts of the world. And I think also in this forum, there probably is a lot of agreement on the fact that the lack of a deep and large capital markets at European level. I would also say the banking union is not totally complete. The fragmentation of financial markets in Europe is hindering our ability to mobilize these investments. This is not a new issue. This has been here for very long. There have been all these reports. I have just realized many of them made by Italian leaders. I mean, Giovannini, and now, of course, we have Letta, and we're awaiting Draghi's report. And they all come to the same conclusions, but we've been for many years trying from the European institutions without having a total success. So I'm sure you will now go on to ask about what can we do and what should be the priorities. So, but let me start by saying the short answer is this lack of integrated financial markets is certainly one of the reasons for this dragging behind.
Just in very general terms, how does the EIB's work actually address the problem? Why do we get more investment because of what the EIB does, which you surely will tell us is happening? It would be even worse, I guess, without what the EIB does. I'll ask you in a second, where you hope to go from here. But just in general, what does the EIB actually contribute?
Well, the European Investment Bank is in itself a capital market union instrument. Because we do mobilize, we serve as a channel between into investments, and we mobilize private investment. We mobilize the capital endowment of the bank, and also mandates and guarantees coming from the European budget. And I would argue it has been an excellent business for European countries, because with the 22 billion euros that have paid in capital, we have mobilized 5 trillion euros in investment. Every year we invest around 88 billion euros, 90% of it inside the EU. So effectively, all the large infrastructures that have been built in Europe have been financed or have had a participation of the EIB. Many of the top technology, green transition-related investments have been financed by the EIB. Even the BioNTech, the company that developed the vaccine, had been financed by the EIB. So many people don't know, but we're actually underpinning many of these investments. And our contribution is twofold. First, the financial advantage. strong AAA rating, very strong balance sheet allows us to provide good financing conditions, but maybe just as importantly, technical expertise. Once the teams in the EIB say, this is a good project, we're going to invest, many other investors come in. And that is why I was referring to this leverage ability of the EIB to mobilize private investment. And we're doing it. It's not just an idea. This is, we're a real life example of how public action can actually mobilize private investment.
You mentioned that financial fragmentation is one of the big obstacles here. Why is it so difficult? I mean, you've sat around the table of finance ministers that should be making this happen.
Yeah.
So,
well, I'm going to be here not very politically correct, and I'm going to be quite candid in telling you, having been for many years, and some colleagues here know having devoted a lot of time, effort, and personal investment, into the banking union and the capital markets union when I was responsible for financial regulation in the Commission, then afterwards as a minister also in Spain. I devoted a lot of effort with a top-down approach. So this idea of you need a single supervisor, a single rule book, you need to remove the barriers between the countries. This is quite straightforward. And I think everybody agrees, actually, in general. When you get down to what does this mean? Does it mean that everything should be in Frankfurt? Everything should be in Paris? What is the role of Amsterdam? What about large and small member states that have specialized, some of them precisely in some sort of investment funds? Is this meaning that we're going to lose this competitive edge, this competitive advantage? So it is when you go down into the nuts and bolts that the thing starts to become complicated. So since now I am no longer a politician or a policymaker or putting forward the legislative initiatives, what I plan to do in the EIB, and I see there is a growing appetite for it, is try to do it bottom up, so that we build on our role as an instrument for the Capital Market Union and try to scale up what we're already doing. For example, we launched last year the European Tech Champions Initiative with contributions from member states, mostly, also part of our capital. And this is has already mobilized 1 billion euros in investment for scaling up startups in Europe. This is a great success, and so we should scale it up. Let's see how we can really become a key player. We're already the largest public venture capital investor in Europe, the European Investment Fund is. Can we scale this up? Likewise with green bonds. We were, the European Investment Bank was the first institution to issue green bonds. We've been spearheading these markets since 2007. Can we then see how to mobilize the green bond market in Europe? Can we do more in terms of standardization of instruments and then scaling up these instruments when it comes to the retrofitting of the housing portfolio in Europe? We need to do massive investments for energy efficiency in SMEs, also in houses and buildings. Can we do something to create instruments that can be easily scaled up and therefore have an impact, So all these are ideas which should allow us to build and strengthen the ability of Europe to channel savings to investments. We were just before saying, actually, the savings are there. We have the large insurance companies, also investment funds are not comparable to the American investment funds, but how can we scale them up and also channel those savings into European investments inside the EU?
The savings are there, but a lot of them go out of the EU, right? So Letta in his report and also President Macron in his Europe speech the other month pointed out that there are these 300 billion that flow out of the EU, mostly to the US, that finance investments elsewhere. Why aren't we better at getting this money to actually pick investments here?
Well, again, because many of the investments mean you are investing in, let's talk about renewables. You're investing in renewables in Spain or in Italy or in Germany, or you're never having an investment which is for the whole of Europe. And the obstacles are very much into the nitty-gritty of what all these very bright reports have been saying for decades now, you know. It is the withholding tax, it is the tax systems generally, it is legislation about ownership, transfer of ownership, risk management, insolvency laws, you know, all these things make a difference. So we have identified the issues. I think that through the initiatives that we can spearhead from the European Investment Bank, working very closely with the national promotional banks, with the private institutions, they're all very interested to work together so that we can really identify where the obstacles are and try to then, I was going to say put pressure, let's say nudge, you know, gently make a difference in terms of the top-down approach, which I am sure will take place in the next Commission. I know Commissioner McGuinness has been talking about it this morning. You know, we need to have a clear agenda, prioritize, and get things done in the next mandate. I think the EIB can contribute bottom up on the ground.
And I anticipate here a little bit when we're going to go into your new missions and priorities. You've set out 8 of them for the EIB. One of them is to contribute to Capital Markets Union. So just before we let that go, I mean, I appreciate your point about how the EIB can work at the bottom up and just make some of these investments happen. But before we let go of the top-down thing, I mean, what are you are an institution that does cross-border or pan-European investment. So what are your, you know, top 1 or 2 or 3 things that you would say that the politicians need to get done? I mean, do you need more centralized supervision to get CMU to happen? What are the 1 or 2 top things you would advise at least or encourage
well, certainly, and the Letta report is very much spot on in saying, and we did do a big push in the last 10, 15 years in moving to regulations. We need to ensure that words mean exactly the same everywhere in Europe. Centralized supervision and seeing how to reinforce the existing framework in Europe would certainly also help, because then international investors and also players can, you know, the rules are quite clear. And also you avoid forum shopping, which is obviously also a weakness. That it does weaken the trust that is necessary for all these processes to move forward. I think trust is a key concept that we would need, you know, in order for this to really make a major breakthrough. And from this point of view, I think single supervision, single regulation, definitely. And we will have to make a decision whether it's harmonization or it is a 28th regime. Do we need a 28th regime so that a specific Europe-wide regime for some areas, for some investments, so that we can really move fast in making this a unified, a single market?
You think that's a sensible idea? That could be a good way.
I think we will be confronted and with this idea, I suspect, you know, very soon.
I mentioned that you've set out 8 priorities. I'd really like you to tell us about where you see the EIB going from here. You're still at the start of your mandate. Maybe we're not going to go through all 8. Let me just ask very broadly, where do you go from here? What is it that's going to change or be new? What is it that you'll keep? What's the vision?
Well, the most important thing I would, and that's priority number 1 for us, is consolidating our role as the climate bank. And in these days where there's so much political discussion and so much noise about it, I think for Europe it's a no-brainer that we really have to keep leading the green transition, and the sooner the better. All analyses, all reports are clear that an orderly transition is cheaper, is much more efficient, and would allow us to keep a leadership, which we have and that we need to preserve. That's part of the competitiveness of our economy. And that means having the cheapest and cleanest energy as soon as possible. So after what happened to us and the wake-up call of these being at the heart of our strategic autonomy, businesses, companies are getting on with it. And we certainly, the European Investment Bank is playing a key role to support the green transition in Europe. For example, we are investing in those technologies that will be key for the net zero economy, from circular battery gigafactories to solar panel manufacturing, but also, of course, the transition in the car industry. disruptive innovations and also scaling up existing mature technologies, green hydrogen, grids and interconnectors. We are really the top and the key investor in this area, and also very important player when it comes to mitigation, for example, water infrastructures, etc., supporting the agriculture sector and the rest of the economy, retrofitting houses, I already mentioned this. So green will continue to be top priority for us. Then accelerating digitalization and these new technologies, including the whole value chain, critical raw materials. I mean, Vice President Nicola Baer, who's here with me today, she's very much committed to support our actions and supporting investments in critical raw materials, having to do with our strategic autonomy also. That's number two. And then goes defense, cohesion policy, agriculture, bioeconomy, food security, also social infrastructures, health, education and skills, also housing, which is a top priority throughout the whole EU for all governments. And focusing, let me close by signaling a point which is also a top priority for us, which is focusing on impact investments outside the EU. Around 10% of our investments, around 8 billion a year, are devoted to investments to the rest of the world outside the EU. We have strategic partnerships which have a lot of impact with the World Health Organization. For example, we are financing the End Polio project to end polio for good in the world, or with the Vaccine Alliance establishing vaccine production facilities in Africa. So these are really important alliances. But right now, the top priority is supporting Ukraine, a successful enlargement, supporting our neighborhood, Africa. So focusing our investments outside the EU is also going to be an important priority going forward.
So let's address some of those specifics in a second. But as a general follow-up on that, I mean, all of these are very impressive ambitions, but you need to get your capital back. So there's a limit to what you can put money into. You have to put money into things where your capital comes back. That's how you have such a high credit rating. So what you can offer is the best terms of financing that can be had, but still you can't go into loss-making projects. So there's sort of, you depend a bit for some of these new technologies maybe, or some of the green things that have big positive externalities. You depend on another side of both national and European government action to have the grant offers, the subsidy offers, and so on. Is that where it should be? Is there enough of that? Or are you, in a sense, are you a bit constrained in finding as many projects you'd like to finance because the grant support that may be needed for some kinds of marginal things isn't there?
Well, if you talk to our teams, there is always a pressure for us to remain competitive, from the financial point of view. And this varies depending on the moment, depending on the liquidity in the market, the interest rates, etc. But the EIB has another very important feature which makes it different from commercial banks or investment banks: technical expertise. So this part, the technical analysis and the technical advice, the technical support we provide in designing and shaping up the projects from the financial, but also from the technical engineering point of view, to be clear, this makes the EIB a very important partner, able to catalyze, a catalyzing element, in terms of, and the fact that we are long-term patient investors also is very important. I was mentioning this Northvolt gigafactory in Sweden. I was very impressed by the fact that we supported the project when it was a startup. We helped the first phase, and now we have supported with 1 billion euros investment the extension of the plant. So we have different financial instruments, and we can accompany a project for years. It's not just one project, one operation. We know the clients and we follow them throughout their life cycle, and I think this is something we need to build more on. But you touched upon the blending capacity. Do we need grants to be more competitive, to be more supportive? I would say the symbiosis between the European budget and the EIB is really of the essence. Because of the guarantees and mandates we get, which allow us to invest in Ukraine right now, to take the risk in Ukraine, because we have the backup, the guarantees from the EU budget, and preserve our AAA rating. but also because the blending between grants and loans coming from the EIB or other financial instruments, I think will be also essential going forward to maximize the leverage and the impact of public funding.
There's a criticism you sometimes hear of the EU budget, and maybe specifically the Recovery Fund, Next Gen EU, that it finances green transition projects and digital transition projects, but it doesn't focus enough on the cross-border dimension within Europe. So it's all quite sort of national projects, and there isn't enough capital going into, let's say, interconnectors for the grid across borders. Do you agree with that criticism first? And second, how can the EIB help to address that?
Mm-hmm. Well, these are very different matters, because I think that and here I have to say, having been the leader in the design of the Recovery and Resilience Plan in Spain, it was extremely difficult, but it's probably one of the recovery plans that does have cross-border investments and projects with Portugal and with France. But it was very difficult in such a short period of time to actually build it up. You know, probably we have to see this as a one-off example, in particular with Portugal. But generally, it was the planning and the speed required for it to be very much focused on the national dimension. But still, the European budget has the Connecting Europe facility. It has other instruments that should allow us to really strengthen our interconnectors, energy, but also transport interconnectors throughout the whole EU. And here, the EIB is an unavoidable, I would say, partner, because we are financing the large grids, the green hydrogen corridors, the international electricity interconnectors, and also railway infrastructures, rail stock, also investment. So we will certainly play a very important role going forward, as we are already doing.
So just to understand, you're pushing back a bit at this idea that we're not doing enough at the cross-border dimension.
I think there is a lot that's going on, but we need to maintain it or scale it up going forward, because the needs and the needs in terms of our infrastructures are enormous, of course.
Since you mentioned Northvolt, I just want to ask, because that was one of the companies where we heard that they, after the Inflation Reduction Act in the US, they were thinking, oh, you know, maybe we should set up something in North America. And of course, we've heard a lot of claims about this, normally on an anecdotal basis, company to company. Is this a problem, as you see it, that companies have decided to invest less in the EU in order to invest more in North America?
I'm sure there are other people who are best placed to reply to that question. Let me say that we certainly are playing an important role in ensuring that Europe is developing these key investments. I mentioned solar panels, also chip manufacturing in France, making, you know, the Iberian Peninsula a reference point for renewables and chip energy. So I think we have to focus on, more than focusing always on this competition outside, let's focus in maximizing productivity inside the EU and having good opportunities in the EU, you know.
One of your priorities is cohesion. I mean, cohesion, the origin of the whole policy had to do with fears that single market integration in general would lead to winners and losers. And of course, most European countries, if not all, have seen increased regional disparities over the last 3-4 decades. We're at a financial integration conference, so I thought I would ask you whether financial integration, if we do get a more unified, integrated capital market and banking market for that matter, are there cohesion risks coming from that need to be addressed? And more generally, how do you think about cohesion at the EIB? So you have it as a priority, but what does it mean in terms of how you actually do your business of lending to address cohesion problem?
Well, we invest around 45% of our investments are in cohesion regions. Right. It is within the mandate of the EIB, and so we are particularly minded to support regions which are less advanced, you know, and in many cases we are the only investor that is actually, you know, mobilizing activity in these regions. And I think this is a top priority and should continue to be a top priority, because talent is equally distributed throughout the world, but opportunities are not. So we have every interest in bringing opportunities where talent is and ideas are, and it means bringing opportunities throughout the whole EU. But also from a political point of view, I mean, what we see is that there are regions in Europe that have been lagging behind and have moved down in terms of the well-being of the citizens for the last decades. And these people feel that Europe and their political leaders are not delivering on their expectations, and they're frustrated, and they also feel insecure. So Europe needs to deliver on its promise of prosperity, which it has been doing since its inception, but it means reaching out to all regions inside the EU. And so going forward, I think that we will need to see how to also maximize the impact of the European budget and the EIB. I don't think we will be able not to have a public intervention to support and to make sure indeed that this risk does not materialize. As in the 80s, the risk was of the integration of the market, to be of the single market project to be leading to this concentration in most prosperous regions.
So your role as the EIB is in part, I think I hear you saying, is to kind of tilt the allocation of finance from what a completely a market without any intervention, without any public bodies would do, to tilt some of that credit flow to the falling behind regions.
But yes, and it's not just because it's the right thing to do, it's also the smart thing to do, because we need to have a diversified portfolio. So in order, we need to have a portfolio that has different types of investments, are extremely low non-performing ratios, in terms of the loans, and the high quality of our portfolio. Forcibly, it requires that we have a geographically diversified portfolio, but also in the types of investments we take. So we can really be investing in cross-cutting border new technologies, which are extremely risky, but we are also investing in infrastructures in more mature or different areas in the EU. That is what makes, I think, the EIB so strong.
You're clearly very excited about what the EIB can do. You have requested publicly to lift one limit on how much you can use your balance sheet to lend, what's called the gearing ratio, or a cap on your gearing ratio. Can you tell us what it is, what the issue is, and what it is you would like to see happen?
Yes, many international financial institutions have these sort of statutory gearing ratios, which are capping the absolute size of the balance sheet. In our case, it is capped at 250% of our subscribed capital, which is also written, the number is written in the statutes. So this is a totally risk-insensitive measure, which in practice means that a mandate, which has a guarantee, which for the own capital of the bank would be zero risk, is assessed the same way as a normal investment done with our own capital, and it penalizes specifically investments into the capital of other companies. So equity investments are particularly penalized by this kind of gearing ratio. So going forward, we want to be able to maintain the annual volumes that we have been doing in recent years. And I expect governors on Friday to support that we just move the gearing ratio from the statutes to the Board of Governors to decide, and that they also agree to increase it in a manner which would allow us in the coming years to continue to do the same volumes.
So your balance sheet currently is around 450 billion, is that right?
It's more close to 600.
600, and you would like that, so would making this change that you're requesting, would that allow you to expand that, or is it that it would allow you to change the composition of the...
What happens is, since we are very long-term investors, the balance sheet, the loans are long-term loans. So my balance sheet, or our balance sheet, is very large, but it doesn't mean that we're taking on additional risks, and to a certain extent. So we have to do a more efficient balance sheet management. This is something that we're also working on. But in the short run, the balance sheet is not going to go down, and so this would, in practice, require that we reduce our annual volumes going forward. And frankly, you cannot have a strong contribution with a shrinking balance sheet.
Right. Yeah. Right. You did mention the frustrations that have happened in struggling regions when regional disparities have occurred, and of course we've seen some of the political fallout from that with the rise of political forces that are quite skeptical of a kind of pan-European, com-European approach to most things. We saw that in the European elections. we obviously have some political turmoil in France at the moment. Are you, are you worried that the political will to do all these things we've talked about is getting a little bit shaky?
No, because I think that these, again, it's not only the right, but also the smart thing to do, you know, to invest in and accelerate the green transition, to ensure that Europe continues to be a leader in the key technologies for the future. I don't think that these priorities, they have been unanimously supported by all my interlocutors and the leaders, and they are sort of very much commonsensical, as you know, as everybody understands. So I don't see it as such for the European Investment Bank, but I do see that citizens, and that's what I have seen in these last years, and we've gone through a lot in the last 5 years, citizens feel uncertain and it's very easy to fuel fear, you know, in a population that has gone through so many unexpected developments in the last years. And on substance, there's a new world order which is in the making, and the geopolitical tensions are around us and are not going down, but rather going up, you know. So there's also a question on all the elements that have been underlying the strength of Europe and a strong voice of Europe in the world, and this also creates uncertainties. But when we look back, and when I look and try to do the balance of the mandate that is now coming to an end, I think there are many elements that should give us confidence and that should make us proud, because actually we did respond to the pandemic in a good manner. We preserved financial stability in the European Union. We preserved also growth and jobs in the European Union and the economic tissue of our countries. We did an excellent job in ensuring that the health situation was overcome as soon as possible. And we were also leading vaccine donation to the rest of the world, you know. And now with Russia, we're also reinforcing our energy markets, and we are taking the measures that should allow us to be stronger in this new geopolitical order. So I would hope, you know, that these messages are really permeating our societies so that we have more confidence in the future, knowing that Europe has gone through crisis all the time. You know, it's a history that starts in the ashes of the Second World War, and I cannot remember a year where there was not a crisis somewhere in the European Union, you know? So if there's one thing that this union has shown is resilience. We should build on that going forward, you know?
We started a little bit late, so I think there's time for one question from the audience, if anyone has one, before we move to the next bit of the program. Anyone who wants to ask a question? I have more, but... Okay, yeah, the gentleman there, please. Is there somebody who has a mic? Somebody's coming with a mic. 3 people are coming with mics.
Yeah,
keep it short, please.
Yeah, one mic is enough. So we talked a lot about...
Introduce yourself, please.
Malte Hagsplitter from the German Central Bank. So we talked a lot about integration this morning, and you mentioned a few things that could be improved for further integration. But do you think, like, what is the most desirable and maybe realistic way to get ahead? Is it like tiny incremental baby steps, or is it going to be a big bang where we make kind of progress in Europe?
It has to be a big bang, because we've already taken all the incremental tiny steps. And, you know, for the last 10 years, 14 years, we've been taking measures, and the low-hanging fruit and all the possible steps have been taken. Under the Spanish presidency, we did push and got success in so many files. But that's that, you know, now we're getting to the core, we're getting to the difficult part. And I really think there needs to be a top political engagement, and it has to be, I don't know whether a big bang in the sense of everything at the same time. Normally packages are easier to get through, but it needs to be something which is material. You know, I don't think we can be for 5 years, again, beating around the bush. And as I was saying, this is a top priority for the EIB, and I hope we can contribute also in identifying what can be the game changers in this area.
It's interesting that Commissioner McGuinness this morning before you arrived used the same term about the low-hanging fruit have sort of been picked, so now is the time for more ambition. So the ambition level is clearly present, and it sounds like you are more optimistic about the next institutional cycle than many people are, but it may be because there is no realistic alternative. But there's also no realistic alternative to us ending now because we have to move on with the rest of the program. So it just remains for me to say thank you so much, Nadia Calvino. Please join me in thanking her. Very good to see you. Thank you.
So, ladies and gentlemen, after this very inspiring fireside chat, we will start this panel, which I think fits very well. It's a nice bridge to what Ms. Calvino was speaking about also in terms of what has been done, what may need to be done, what further steps may be needed on the Capital Markets Union, and what we're going to focus a little bit on in the next 90 minutes or so. I should clearly stay away from that one. In the next 90 minutes or so is the consolidation of the EU trading landscape and stock market. Actually, an issue which has been a little bit alluded to during this morning already. I'm not going to speak about that myself, but I'm joined here by a very distinguished group of speakers that I'm going to introduce very briefly. I will not read the CVs, that would take far too long, but just to mention very briefly to you who you have here on the panel together with me. I have Athanasios Koloredas from the Greek Union of chairman of the management committee of the Greek Union of Listed Companies, to be very precise. Next to my right, I have Petr Koblit, CEO of Prague Stock Exchange, and also the president of the Federation of European Securities Exchanges, so FESE. We have Javier Hernani, CEO of the my Spanish is not what it should be, Bolsas y Mercados Español, so BME. We then have Gunjan she's the global head of capital markets and market intelligence, State Street Global Advisors. And last but absolutely not least, Johan Almegren, Swedish State Secretary for Financial Markets. So you really have, I think, the top of the top to speak here to this topic. And I also think, or I know actually we're going to have slightly different points of view here, which I think will probably ensure that we get a very interesting panel. The way I intend to run this is to have first the speakers will get the opportunity to give some very short introductory remarks, sharing their perspectives, and then we're going to run this in terms of 2 rounds of questions. And given that we have 90 minutes, which is quite generous, we will also have the opportunity to take some questions here from the room, but also from colleagues that are joining online. And I know that we are what's standing between you and your lunch, so we will also try to finish in time if we can. So without further ado, we will start the first round. And as a little bit of a, let's say, opening question here to the panelists, what are your views on the current landscape for trading and post-trading, by the way? And we're speaking about the EU, of course, although I'm sure that the US will be mentioned as well. Would further consolidation be beneficial? Are the main challenges we see actually due to this fragmentation? And I think the fragmentation has been mentioned a lot this morning by all speakers. Or do we have broader issues that we actually probably need to target rather than focusing too much on the consolidation? So this is, again, a short round, 3-4 minutes each. And I will start with you, Johan.
Thank you, Paulina. It's a real pleasure to be here. So first of all, let me say that I'm trying to think about whether the glass is half empty or half full when thinking about the current landscape. So if you think about trading, clearing, settlement, essentially these are very tech-intensive operations. So it's easy to see that there are returns to scale. You would have a business case for consolidation. And yet when we look around Europe, we see that a lot of these operations still have a sort of national character. So something seems to be amiss, and from that perspective, perhaps the glass is half empty. On the other hand, I think you could also argue that the glass is half full, and here I think, to start with, it's good to remember where we're coming from. So there was a lot more fragmentation in this space if you go back a few decades. In particular, we had features such as a lot of regional stock exchanges even. There was a wave of consolidation, at least in the 90s. I think this country is one example, Italy is another, Spain is one. So there has been a lot of consolidation. What we also see in more recent years is consolidation in the form of having one firm with many faces in a sense. So horizontal and vertical integration, where really a handful of firms are actually active in a lot of these areas across Europe. So I think you could argue that there is quite a lot going on here. Nonetheless, there do seem to be some thresholds in a sense. Maybe it's something that's preventing this from moving further. So that's easiest, I think, to see in the CSD space, where the comparison with the US seems quite relevant. So I think, is this a problem or not? It's good to think about, why would this be a problem? Is there a market failure? Not so easy to see. Are there unintended consequences of other regulations? Here, I think it's been mentioned by several people already this morning, the legal frameworks, the fact that national jurisdictions in other areas, not least company law, insolvency law, tax rules, seem to be reinforcing some of these national boundaries. And that might have unintended consequences that could actually be a problem in this space. Then the question is, a problem for whom? So is it a problem for firms? Probably a little bit. In Sweden, we have rich listing activity, so that's not so much an issue for us, but I know it looks very different across Europe. I will say, though, not to forget that there are other ways for firms to also find capital. So let's not forget that UCITS has been a tremendous success story. If LTIF could achieve even a fraction of that success, that would be a very important step in the right direction. We've also seen tremendous growth in the private equity domain in the last couple of decades, and that's very important for the more unlisted firms. So there are other channels. Perhaps it's not quite as big a problem for the firms as it's sometimes made to be. I think it is a problem for the perception of the single market, for sure. And there it's very welcome to have this discussion in the reports by Letta and Noyer and so on. Finally, I would say, is it a problem for savers? And here the experience across Europe is very different. In Sweden, households have considerable exposure to stock markets, and it's in particular thanks to things that are, frankly, national levers that you can pull. So maybe a lot of low-hanging fruit has already been picked for financial integration. In terms of the sort of mobilizing capital, encouraging people to invest in stocks, there is, I think, still low-hanging fruit across Europe. In Sweden, it's really had a lot to do with how you design your pension system, both the public and occupational schemes, and how you design your tax code. Happy to share more about that later today.
Thank you very much, Johan. A lot of food for thought, low-hanging fruit and food for thought. I think clearly the Swedish experience is, of course, very interesting here. And as you alluded to, national pension systems, the tax systems, tax incentives do play a role here if we look at the bigger picture. And we will have the opportunity to come back to some of these issues later in the discussion. But I will turn to Javier now.
Thank you. Thank you, Paulina. Thank you very much for having me today. I have the impression that I'm going to be the rebel here in terms of what we are discussing. I think fragmentation is a big word, and it's very political, and it's very easy to use, and it's more difficult to define. What is fragmentation in trading? What is fragmentation in post-trading? And why are we here today discussing these things? First of all, I think we are discussing because we, at least is my opinion, we are really worried and concerned that there is no capital flowing efficiently into the European markets. Is this a question of how fragmented that the trading venues in Europe is not? what is really the fragmentation playing a role in this subject? Do you really believe that if we had one single platform, we would have better capital inflows in the European market? I don't. First of all, if we talk about fragmentation, we're always talking about exchanges. It's always like, as you mentioned, Johan, the regional exchanges. Now, we have in this moment, and I counted this morning with my iPhone and my glasses, so it's probably not right. We have 190 systematic internalizers, 190, 90. 280 trading venues. How many exchanges out of that? So the regulation, the European regulation has pushed for fragmentation because it pushed for competition. And now we are here in a situation in which 30 or 40% of the total liquidity of the market is not lit, is opaque, is in the hands of systematic internalizers. And this is killing the trading between auctions. And this is what is happening. So are we worried about liquidity in the markets? Then we should be worried really about the systematic internalizers' effect into the liquidity that is available for companies. When I talk to issuers, and I do it all the time, what some banks tell them to go to the US is because they show that the trading platforms have a better liquidity. We are showing worse liquidity from 5 to 10 years ago. So is this, the fragmentation is what? That's the first question. Second, in post-trade, okay, in post-trade, we talk about post-trade as a single thing. Post-trade is a very interesting, I tell you, it's a plumbers, I know. I also had the security services the unit in 6 Group. It's very complex, but it's very interesting. Is there fragmentation in clearing? We compare ourselves to the US. Here we have Rafa Plata from each. Well, I mean, in cash clearing, there are clear tools like the preferred CCP rules, like the interoperability rules, which is clearly, in my opinion, devising already a common space for clearing. It will take time, but some of the rules are already there. In CSDs, my God, we're talking about 32 CSDs, who has completely forgotten that we have a T2S. We have 20 CSDs connected to a single settlement engine, which is the ECB. We're here. So we have one single settlement point for all Euro securities in the hands of the ECB. So we're talking about fragmentation here? I don't believe it. What do CSDs do? CSDs do 3 things. One is settlement, used to do, and now it's the ECB. The other one is notary functions. So are we saying that we want one notary in Europe? I want to be that guy. So we're giving all notary functions to one single CSD? Is that what we want? No competition in CSDs? That's what I believe. I mean, notary functions are very important and obviously very also related to the granular ecosystem of where the companies are, so on and so forth. And I'm sure Peter will say something like this. And the 4th thing is custody. So we do settlement, we do notary issuance, and we do custody. Are we saying we want to give all custody to one single CSD? Is that what we want? Then we should also ask for a custodian banks merger, no? Why should we have one single CSD for custody and we have a number of custodian banks in Europe? So what do we want? We want competition, we want efficiency. If we talk about efficiency and why and how can we compete with the US for liquidity, for better markets, for better capital allocation, let's have it. And I'll have my moderate contribution later. Thank you.
Thank you very much. I think the word that kind of strikes me as policymaker, what we like a lot in the European Commission is, of course, kind of finding that balance between, I guess, the, ensuring the efficiency and the competitiveness. I guess we should not maybe focus too much on the number of actors, but more look a little bit deeper on how things are actually working. But anyway, we will have the opportunity to get back to all these issues. And Peter, over to you.
Okay. So thank you very much, and thank you for the invitation. I would probably a little bit follow on what Javier was saying. I was supposed to actually talk to the last one that there are not 2 exchanges talking after each other. Then it looks that we are really forming a block here. But yeah, there is kind of elephant in the room. We are a lot talking about the improvement of the markets and. Everybody knows who's watching the capital markets how far we are lagging behind the United States. some of us say, we don't want to be compared. We are also good. We in Europe, have other features, not only this rough thing, US capital markets. We have a more social view and other things. Yes, well, don't be mistaken. I'm a proud European, but when it comes to the capital markets, it's about issuers, it's about investment banks, and it's about investors. And these guys can read hard numbers. They want to make money, and they want to spend as little as possible. And they are pointing at the United States as more liquid market, more efficient market, more deeper market, and sometimes even better valued market. So we have to look a lot in the United States, what they are doing and how they are doing the things. And I'm not saying that we should immediately merge all the CSDs into one DTCC, that obviously are those problems which Rafael was mentioning, and I completely assign it. There are so many issues around. We heard a lot of them already in the morning, especially from Commissioner McGuinness. I probably don't want to repeat all of them. So this unified solvency law, securities law, maybe 28th regime, I would probably pick one thing, and those are the withholding tax or on dividends and coupons. We have just been discussing before in a small circle here how big nightmare is for a citizen of Spain. I was discussing with Rafael to invest in French equities. Do you think it's a nightmare for a citizen of Mississippi to invest in New York equities? It's not. So do you think there's a problem for a citizen in Washington state to invest through the bank, which is based in New York, on the exchange, which is based in New York, to the Florida startup? No, it's not. It's very easy. In Europe, you don't even know about those deals. Me as a Czech, I would not even get access to the list of the deals which are on BME right now being subscribed in IPO. And even if I would find it somewhere, which is on the pages of my colleagues, there would be no way I can invest in. No way. Due to the regulation, due to the lack of interoperability of the investment banks. Actually, I will speak about it later if I get an opportunity, how the investment banks are, kind of covering the region. We definitely have to unlock this kind of savings, and especially pension savings. It's great that we have Johan here, because I think the example of ESK, I believe it's the name, the long-term pension product, is just a screaming success. And we have it right under our noses in Sweden. Just translate it from the Swedish and copy that to the national regulations, and maybe make some kind of pan-European one, because it's a screaming success and they prove it. So these kind of things are also low-hanging fruit from my point of view. And last but not least, I will say last sentence, there is one topic which me as a representative from the, let's say, new countries, well, what is new is like already 30 years of the European Union, see very importantly. And, for the people sitting in Brussels, Paris, Frankfurt, they don't even know that there is such a kind of problem. It's a problem of the indexes. Europe is split by the index providers into the map of 1989. It is like this. And unless those index providers will not dramatically change the rules, it will be forever. These borders will be there forever. There is no way Slovenia would make it on the recent condition of the index providers into developed market, even if they have a GDP of Switzerland. The rules were written in the 80s and they are still the same. So we, as a European Union, I always urge everybody, look at this problem, try to understand this problem, and speak to the index providers, because that's another split which is under the radar and it's extremely important.
Thank you very much, Peter. I feel we're getting a longer and longer to-do list here. Very useful. By the way, on withholding tax, there was actually a recent agreement on an EU proposal, which I think is an important step forward. But of course, that still needs to be implemented nationally. So we've heard from, in a public perspective, from Johan, we've heard the stock exchanges, and now I turn to Gunjan from the State Street perspective, the private sector. Thank you.
Thank you, Paulina. Appreciate it. So I'm going to have fun sitting next to Javier, given the comments that he made. So Back to your question, what do we want? From an investor perspective, I think we absolutely want to ensure that the investor experience trading on exchange is as positive as it can be. I think we absolutely want there to be as much transparency as there can be. So the three areas from my vantage point that I think are crucial as we consider the question of consolidation of exchanges across the landscape in Europe are threefold. First of all, let's look at the numbers. The lack of growth or the stagnation in average daily trading volumes on the European addressable market is hard to ignore. Over 23 and year-to-date 24, the numbers are still stuck at 48 billion and have not grown. Globally, average daily trading volumes have been growing at 17%. The growth is coming from the US, over 100 billion year over year from 23 to 24. So back to your question, when issuers are looking at where should we look to list, investors are looking at where should we trade, those deep, liquid, transparent markets in the US are really hard to ignore and become quite an attractive proposition for investors. And I think we have to look at something here in Europe to address that. The second area that I'd flag, and again, Javier touched on the point, Peter also in his remarks, 33% of on-exchange trading volumes are what occur across Europe today. 43% is happening off exchange and 11% is in dark pools that are definitely not transparent to any retail investors who want to understand wherever they're trading, what are they getting into? What is the information? How can they access it so that they can make informed decisions? Retail investors are not able to make as informed decisions when the data is not readily available across the European markets. The consolidated tape in the US has added to price transparency. It's added to the data for all investors, institutional or retail, that have access to those insights for price discovery, being able to make informed decisions about where to trade. And I think that's also something that consolidation across exchanges in Europe could really help bring about. And I'm eagerly anticipating the full implementation of the consolidated tape when we get to that towards the end of 25 and 26, which I know the ESMA technical team are working through. The third and final item, we can't ignore RFQs. RFQs continue to grow in what they see for volume of trading. That is taking away, without a doubt, the exchange volumes that could be seen as a result. If you compare, again, in Europe, what we see, and I'll give you some statistics from an ETF perspective, the US market for every primary market dollar traded sees $9 equivalent in the secondary market. Really deep, really mature, very transparent to all investors. In Europe, only $3 trade as an equivalent to every dollar traded in the secondary market. If there isn't as deep a secondary market trading, again, that will form for a large part how investors are making their decisions. As an ETF issuer, I will bring a product to Europe and I will then list that on average across 5 or 6 different exchanges across Europe. Immediately, the liquidity is fragmented. So, from my vantage point, having to explain to an investor where they should then trade, how they should think about trading and where those decisions are made, it's very easy to lose them through that conversation when there is so much choice and so many more decisions to make than there might be perhaps compared to the US marketplace. I'll stop there.
Thank you very much. I mean, consolidated tape, indeed, of course, also something where we have a recent agreement and probably what some would refer to as the famous incremental step towards the CMU, but clearly something that I also, like you, think will be very, very useful once fully implemented. To finish off the first round, last but absolutely not least, Athanasios.
Yes, thank you very much, the organizer, for the invitation. I'm very honored. Well, integration of financial markets is indeed an elusive goal. Efforts have been made for the past 35 to 40 years. And for some, it is a chimera, an unrealistic goal. For others, it's a panacea, a treatment for every European capital market seal, meaning cross-border barriers, illiquidity, etc. So why Greek people always use Greek words, strange Greek words to say simple things? It's meant to be an internal mental flaw. Well, the path to such goal, the consolidation of markets, is not a straight line. And indeed, the strategy that already, it is important to understand the strategy that we are using. And the strategy we are using has two major components. The first is indeed harmonization, regulatory harmonization. And the second is competition. I will disagree with Xavier that fragmentation, that competition leads to fragmentation. This is the means. The end, the goal of the competition is indeed concentration, and I say why. What do we mean with competition? Competition against natural and legal monopolies. Until now, CSDs and stock exchanges used to be, a couple of years ago, legal or natural monopolies in various national laws and countries. But MTFs, cross-border access, freedom to provide service of CSD, they are all rules that they try to fight against increased competition. And competition indeed leads to fragmentation, but speaking also as an academic, the strategy is based on something that is called liquidity bias. Liquidity attracts liquidity. So the idea is a fight between competitors, and the more liquid shall prevail. This is what happened in the US, apparently. Does it work? Not necessarily. Why? We need to find how. But this strategy has some internal flaws. The first flaw is that it relies mainly on big investment banks. And we need to ask what will be the role of smaller investment firms and other providers. The second is that it may lead to the so-called cream skimming. If new alternative venues use local exchanges only for netting their positions and they take the trade themselves, if new venues or the competition between stock exchanges attract the best companies of a local stock exchange, and the local exchanges remain with the second level companies, I mean at the local level, then local exchanges likely will perish. This is what happened in the US. It's not something new. So we need to find a way that we promote financial integration, but we also give a role to all these players. How we can do that? I think this is the 1 billion question. Thank you.
Thank you very much. We will try to find some answers here on the panel. And let's go on to the second round. I think we've already covered a lot of ground, actually. I would, in this second round, invite, of course, also panelists to agree and disagree with what others have said. What we will focus on in the second round, and it's already been covered by several of you, is a little bit the drivers of fragmentation. What are the barriers? Let's maybe not focus too much on fragmentation consolidation, but more what do we want to achieve? We want to achieve high levels of transparency, we want to achieve high levels of liquidity, we want to have efficient markets in the EU. The international comparison, we will, Johan will explain a bit more about the Swedish experience, but the US, of course, comes back a lot in these comparisons as well. Obviously, the US is a bit different, and I'm sure we will have the possibility to touch on that also in this round. So for this round, I will start with Javier. Was following on from what you said earlier, maybe you want to share something about your own experience with the merger of BME and Sixt, but also this kind of EU-US comparison, which I know that you wanted to speak a little bit to. So please.
Thank you. Well, the experience of consolidating BME and Sixt and BME, I think, is very positive. Also because of the touching on the topics that we are dealing with today, in terms of how to make a better market, how to integrate post-trade to the maximum, so we can actually make securities flow in a better way. And clearly, the experience is that this can be done. For example, in post-trade, we've done a couple of things that I think are very interesting, and I think they are neglected by people when we look at the post-trade and we look at the number of CSDs. we tend to forget that we have bilateral accounts between the CSDs of the euro, which means actually that there is a pool of holding of securities within the eurozone that is actually enabled by target to securities. The target to securities is not only about settlement, it's about also the bilateral accounts of the different CSDs with each other, which actually creates a pretty firm and homogeneous set of network of post-trade that I think is extremely unique in this moment. We're trying to put that also in context with the CSDs that we run in the SIX group by having 3 links. There's a link between Iberclear and SIS. So we have a bilateral account that enables settlement and custody to be seamless between the 2 constituencies. And this one is out of the European Union, the other one is inside. And another one that is a digital CSD. So we have a SDX, which is a digital CSD, fully licensed in Switzerland. So we can actually transfer digital to legacy and then legacy to digital in a pretty seamless way. We're starting, but this is clearly an elements of interconnection and interconnectivity, which is what I think what issuers want and what investors want, which is that we make it happen in a more seamless way. So that, in my opinion, works. And again, don't neglect the importance of target to securities. Target to securities, sorry to say this, has been a pain to make it work, sorry. It really took us a long time to ECB and ourselves to make it work properly. So it now works very well. And now is the second stage of target to securities, which is basically how do we make the most of this common settlement platform and common bilateral links network. I think it's extremely important. This is the second phase of T2S is starting now, in my opinion. That's extremely important, not to be neglected when we talk about fragmentation of post-trade with the US. I think, Johan, we don't disagree so much. Everything you say in the first part of opaque trading and everything else, we are absolutely on the same page. I think this is the disaster of regulation in Europe is precisely this one. So we really need to take this into lead markets. And honestly, this is not a low-hanging fruit. It's something we need to do. Either we stop this, either we stop systematic internalizers from taking away liquidity for the market, or we kill the market. That's what it is. It's going to happen in 5 or 10 years, whatever it is. But unless we take decisive action now, I mean, it's worthless that we talk about consolidation or anything else, because honestly, we are here consolidating. I mean, we have to consolidate to minus 190, not to get it consolidated. There's a kind of a mathematical paradox. No? We cannot consolidate to the level that we actually stop that fragmentation. There's no way. So we've done a lot of efforts, but a year after year, there's more fragmentation there. And that, I think, is the biggest difference with the US. The US is a super liquid market. It's absolutely true. We're also losing the narrative, and I stop here because I think I will take too much time. We're also losing the narrative. We're allowing that arguments like liquidity actually influence arguments on valuation. That, sorry, I don't buy. I was a young analyst many years ago, and I've had the opportunity to value many companies. Honestly, if somebody would have come to me with a file without the name and telling me how much is this company, I would have come to 100 of valuation, and then they tell me there is one missing data, a piece of data is listed in the US. I would have said, oh yeah, sorry, 130. Sorry, I mean, this is, to me, is not analytically correct. But I see more and more pieces of information coming on this trend of saying the reality. The reality is that valuation is not better in the US because this is a bigger market. This is not true. I honestly think there is no data that is actually strong behind these kind of things. And we are losing the narrative again. We are losing, and I really welcome this kind of debates. By the way, we tried in Spain with a white book presenting 56 measures in the Spanish market to try to enhance the Spanish market and the listings and everything else. We will talk about it in a minute. We really need to reinvigorate the US market, because otherwise we lose the narrative and our issues will go there unless we tell them the truth. First of all, it's true that it's a liquid market, but not because you go to the US, you get a better valuation. I mean, analysts are not stupid, are they? I wasn't very good, but honestly, I mean, to say that because it's a US listed company, the valuation is higher, I honestly think we really have to fight back against these things, because it's getting into the heads and the brains of our issuers and entrepreneurs. And this is honestly something that we should be very, very mindful of. Thank you.
Thank you very much. I think maybe in general sometimes that we have a bit of a narrative challenge in Europe, and that we sometimes talk ourselves down a little bit. It's a bigger debate, but I think what you said is interesting, Javier. You spoke a little bit directly to Gunjan, so I will go back to you also. You already shared a little bit your perspective on the comparison between the EU and the US, but maybe you want to also react a little bit to what Javier said.
Yeah, look, I think there are absolutely elements that we need to learn lessons from, but we also shouldn't be caught out by the red herring statements, which I think is what you were addressing. Bigger doesn't always mean better. And let's just talk about liquidity. So when I'm thinking of what's the impact of a fragmented market, I'm thinking about what does that mean for the end investor in accessing liquidity. So first of all, the market makers, those who trade across the secondary market, liquidity is still available, even in a fragmented market. But if you double click, what's the cost of that fragmented liquidity? And that's where I come back to the investor experience. So our data shows us when you are across the European market, having to navigate so much fragmentation, coupled with the fact that the majority of the volume trades off exchange, it's not even on exchange, the execution experience for end investors is definitely poorer than it is in the US when I look at where ETFs broadly are executed. So I can't help but think that that does have something to do with accessing larger pools of liquidity in a single venue. The second item I would stress is I think that there are market structure changes that are needed in Europe. And I also think that there is policy, anything around policy that can come to fruition that also drives just greater transparency and a more of an even playing field for all investor types, in particular for retail, to access the same data and information to make those informed decisions, I think is going to be helpful. So again, you know, without harping on to the point, the real-time transaction data that is made available in the US is absolutely a game changer. And I look forward, as I said earlier in my comments, to seeing that come to fruition in the marketplace over here, because I think that type of a structural change benefits all investors.
Thank you very much. We will, in the next round, get back to a little bit, you know, what concrete policy measures could be useful here. You have mentioned a lot between yourselves here already, but we will still come back to that in the next round. Retail investment was, I think, a very important point just mentioned by Gunjan, and that's a perfect bridge to Johan, because Sweden has, of course, in contrast maybe to some of the other markets in Europe, I guess a long tradition of citizens taking, you know, buying shares, giving the grandchildren shares for the birthday and all that. So please speak a little bit to the Swedish experience, and it does come up a lot. And of course, I'm a little bit biased here, being Swedish by passport myself, but I think it is interesting to see how the Swedish example is being mentioned a lot in various panels and conferences these days. So, but you know, we should listen to the person who actually know how it works there. So please, Johan.
Thank you, Paulina. Well, let me try to mention a few features of the Swedish system, also just to add nuance. I think our capital markets do work well. That said, there is a trade-off here, I think, between returns to scale, what seems to be efficiencies from consolidation on the one hand, and also safeguarding competition. I should make it clear, Sweden is a small country. We have 10 million people. We have 2 regulated markets. We also have 3 SME growth markets. So there is actually quite a lot of competition, even within that small system, and our largest trading venue is not owned by the same company as the CST in Sweden either. So I think it's not all about consolidation, and that echoes what I think some other people have said here too, worth bearing in mind. I think also it's important to see the sort of local ecosystem around a well-functioning market for issuers. You have all these legal, financial, advisory capacities that really, I think, take a long time to build. And once you have them in place, I think they're very beneficial for issuers, but they're also beneficial for other players in the local financial market. So in that sense, a sweeping consolidation in this area in Europe would probably have some negative consequences in some member states. I think we should be wary of that, at least, recognize that there's some sort of trade-off there. Third, then, coming into the retail investor perspective, I think it was a good point made earlier here by Peter about interoperability. I mean, really for the retail investor, I think it's two things that we should be encouraging. One is exposure to stock markets, for sure, but the second is proper diversification. These tend to be the two big glaring errors in household portfolios: not enough stocks and not enough diversification. So exposure to stocks, Sweden has done very well. The ISK that was mentioned, thank you for the kind words. It's basically an equity-friendly tax treatment, directly held stocks from mutual funds, no lock-in. You can sell, get out whenever you want. You don't get any more taxes when you realize capital gains. Actual distributions aren't taxed. Basically, you pay something like 1 to 1.5% a year, more or less like a flat rate. And then you don't have any other taxes or really paperwork. So it's very simple, very equity-friendly. I should say it was introduced in 2012. And now, out of those 10 million people I mentioned, 4 million have an ISK. And the assets in the ISK are about 1/3 of GDP. So that's pretty successful. It's not coming out of nowhere. It's the most recent version of some way putting a wrapper somehow around savings with a stock market exposure, but it's the one that's been the most clearly targeted towards directly held stocks. I should say one last feature of that product is that it's not a savings product really in itself. There's no layer in between. It's a way of keeping track. Did you or did you not pre-select to have that tax treatment? You can't decide later on, because then everything that performs really well, you would tax it like that, and everything else you would tax in the conventional way and deduct losses. So you have to pre-select this treatment. So it's really a matter of keeping accounts. Did you or did you not pre-select for this tax treatment? So when this was introduced in 2012, I was at the Ministry of Finance also then. It was very clear in the communication that there was an expectation that this would be a very cheap thing to have. To have an ISK would probably be provided for free or at a very low fee, and that's also what happened. So you get directly held stocks with really a minimum fee or no fee for that little bit of intermediation. Again, that's another feature to make it more friendly. So I think for Swedish households, what's really missing there is easier access to diversifying portfolios across Europe. Now they can do it relatively easily through UCITS funds, other ways too, but to do it for directly held stocks, if you go out and buy Adidas shoes, take a German example, and you think this is a good product, I like this company, maybe I should have some stocks in this company. That's going to be more difficult than if it's Volvo trucks. It's not obvious why that should be the case in the future. So I think interoperability is going to be a key word here, though. It doesn't have to be a matter of consolidation only. Thank you.
Thank you, Johan. I think there is one element here which would be, would merit its own panel, which we don't have much time for today. And that's, I think, Commissioner referenced it before. And that's, I think, the whole financial competence and financial education piece, which, of course, is also really important part of this retail conversation. If we want consumers to be more active on capital markets, we need to make sure that they get a good deal and that they get good advice and that they, of course, understand what they're doing. But again, that's another debate for another day. So we've spoken a little bit about the Nordics. So we now go to Central Europe. Peter, you've already, mentioned some of the things that I think you seem to suggest that they're holding some developments back. But what are the further challenges that you see from that Central European perspective?
Thank you, Paulina. Maybe you were previously saying that we could react on our speakers before us, So, well, I almost promised to myself that I will not say the word consolidated tape, but yeah, I'm just very glad what Gunjan was saying, that the consolidated tape and the perspective of State Street, that finally somewhere gonna be access for the data of the trades which are done OTC, dark pools and SIs, as I understand it right. Perfect. It's a pity that the investors really didn't say it 5 years ago. We could have spent tons of mental activity, days and nights of discussions because, it could have been done very easily. Consolidated tape from exchanges are on Bloomberg and Reuters. And if there will be a rule that all the SIs, OTC, and dark pools and MTF should also contribute to these two providers which have duopoly, could have been done 3 years ago. I don't know why it was not done like this. You know, we were also always arguing as the exchanges that our tape is out there. The problem is the missing of the data, not that our tape is not out there. So great to hear it, unfortunately too late. Now we're gonna develop a new thing which will cost a lot of things. We are very happy to participate in as exchanges and looking forward that it will improve the market, but I think it could have been done easier. Another thing on consolidation, consolidation of the exchanges. What is the most expensive thing you are running if you are running a financial company at the moment? You are running an IT, that's the most expensive. Then there is some legal cost, you know, usually huge legal cost for regulation and whatever. Of course, the personal, but you know, I mean, like business-wise, then you can spend fortune on marketing, but you don't have to. You know, mandatory are those two things. So let's focus on IT. We exchanges as a segment. We innovate, I think we are running state-of-art systems, and 90% of the trading in Europe is running on just 3 systems. After you will finish your merger, it's going to be probably 99% of 4 systems. The most important, the most difficult, and most costly part we already did. There are just 4 systems, basically, like IT systems. I don't mean the exchanges, but the IT systems. All of the investment banks in the whole world have these 4 systems, or will have these 4, now have these 3 systems in front of their nose. All of them have there also Bloomberg and Refinitiv, and that's the technical equipment they basically need for accessing any market in Europe in the moment. So IT-wise, I would say we cannot go much further. So there is a problem actually on the legal side there. Euronext, and I think you will hear it from Stefan later on, you know, is consolidating the markets in Western Europe for almost 20 years. You know, we were trying to do the same thing in Vienna, and actually we don't have anybody from Nasdaq, you know, doing the same thing in Nordic area. From my experience, we had, as a Wiener Börse, I was also the president of Ljubljana Stock Exchange, and we said, okay, it's so small, the euro, let's try to really merge it. You know, just to give out the Slovenian license and merge it onto one license. Such a thick file came from the lawyers, and they said, "Les, you are mad. It's impossible. It's just legally impossible to do it. You cannot just take the whole market. You can cherry pick. You can pick up 3 or 4 big securities, move it onto your main market, and they'll leave the rest there to die out there. But you cannot take the entire market and integrate it into another market, you know, because the regulators would have to agree on how they're going to do the things. You know, if there is a trade in a Slovenian security on the other markets, simply the lawyer explanation, I don't want to go to the detail, was like, forget it. You will spend a fortune and you will never achieve it. Also, we were looking now in the Prague, Vienna, and then we realized, you know, that it's actually nonsense, you know, because, and now I'm coming to another buzzword, single pool of liquidity. What is it? When somebody says this word, you know, I have to be asked, you know, what do you exactly mean by single pool of liquidity? Is it like all the members on the exchange are trading something? This is a single pool of liquidity, regardless what is listed there? Because not all the members are trading everything. There are some members who are passive investors, they are trading just the index. So it doesn't automatically, we're speaking daily to issuers, to check issuers, it doesn't automatically mean that if they are listed on London Stock Exchange, they have same investors as Royal Dutch Shell. They don't, because they are coming from the different world, they are in the different indices. Back to the index problem, of course. And Prague and Vienna is developed market for 50 years. Prague is so-called emerging market. We are still emerging for 30 years, and we ever gonna be if there are no change in the rule. So we have the same pool of liquidity. Yes, same institutions are members there, but completely different pools of liquidity are trading the stocks, which are Austrian stocks and Czech stocks, Hungarian the same way. So this fiction of the single pool of liquidity, if you're speaking and you are not from the industry, I was sitting for years in front of on the desk and I was trader. You know, just let it be explained what exactly the person who is speaking about single pool of liquidity means and how it can be touched, the single pool of liquidity.
Thank you. And we're then moving on to Athanasios. And maybe I think the bridge actually from what Peter was speaking about, the local exchanges and the difficulties that were clearly in the lawyer and the big file and all that. I think that also goes a little bit to the question that you were asking Commissioner McGuinness earlier. I mean, the role of local exchanges, if ever one managed to do the merger despite all the legal difficulties. I mean, what is your perspective on that? I mean, it's kind of the local perspective from the local investor and his possibilities to then access capital, then no longer locally perhaps, but somewhere else.
Yeah, I will talk from the perspective of the issuer trying to find cross-border investing or internal market investing and not local investing. The main problems are the following. First of all, local companies are usually under the radar of main institutional investors. There is too little information about them, little investment research, and the rules of MiFID II on investment research actually made things worse. And there were many market participants and academics that they said that at the point that they were institutional, they were issued. Second, for Greek companies, for example, there are linguistic barriers. There is little information because they have everything in Greek. Nobody speaks Greek. Yes, sorry. Second, there are linguistic barriers. For example, for Greek companies, everything is in Greek. And if they want to have more information, they need to translate everything to English. Third, let's be frank about this. And it applies in most European companies. They are small in size, with little free float, and little liquidity. And these are not good fundamentals for cross-border investing. And all these fourth are translated to cost. Going public elsewhere, except from your local market, is extremely more expensive than doing that locally. And we have not done anything about this. And this is not only the issue of the capital raise at the first, it's also living with foreign investors expensive. And this translates to the role of proxy advisors. There are so many peculiarities in local corporate laws and local laws that make the relationship between issuers and foreign investors very, very problematic. I will tell you an example. In Greece, we have a preemption right for existing shareholders that works in priority to other investors. This means that you need to do that serially, first for your investors and then for your shareholders, then for other investors. When all Greek systemic banks wanted to recapitalize after the crisis, they abolished this right and they replaced it with a simultaneous allocation right, priority allocation right. It works the same way economically, but it was not the preemption right. Just for reasons of speediness. Okay. All proxy advisors advised against voting in favor of the capital increase. And it was really a nightmare persuading foreign investors in 48 hours in order for these banks to go off with their recapitalization scheme. So this is a very clear example. Sixth, moving cross-border for issuers or doing dual listing is also very problematic because it will require redomiciliation. All Greek companies that they wanted to do a listing, they needed to redomicile in Belgium. And when they go there, they understand they're too small for a bigger market. There is a say that say better second in a village than first in Rome. Okay. And always we need to understand that we have national barriers and we have country risk. And if you are domiciled in Greece, then during the debt crisis, the sovereign debt crisis, you are non-investable anyhow. So these are all barriers that they cannot somehow eliminate by changing the law or something like this. They're inherent in how Europe works. So this is for me. I will keep my proposals in the last answer. Thank you.
Thank you very much. I think it's interesting indeed that we, of course, speak a lot about what can be done. I think the top down versus the bottom up was mentioned by Ms. Calvino and others. But obviously, one aspect here, and I think it was very clear in your intervention, Athanasios, is of course also the more, I mean, the linguistic barriers, the cultural, the kind of, in a way, probably also Europe's richness that we are so different, but that of course these are not things that we can regulate away at the European level. We're going to move into the last round before we will take a few questions from the audience. I think the discussion has already been very, very rich. What I would want the panelists to please focus on in this last round is a little bit the policy implications. And a lot has been mentioned already in terms of the role of SIs, consolidated tape, tax incentives, pension systems, corporate law, insolvency law. So I think you have already touched on a lot of issues here. So I'm going to make it a little bit more difficult for you now. So if you were to advise the next commissioner coming in responsible for financial services, we are of course at an interesting political juncture as what's been referenced in earlier conversations. What is the one measure in terms of policy changes that you would think would really make a difference for Capital Markets Union going forward? So I would ask you to keep it to one measures. We will try that, and I'm starting by going back to you, Peter.
Well, surprising question, and immediately I'm first one to say to speak. No, I think there should be done something on the supervision, really. We need, there will be next panel about that. We need to scrap some of the local gold plating, make all the decisions same question, the same answer in every country. I'm not calling for one European SEC. I think it would not be really effective, but there should be very much unified in their decision making. They should have a single outcomes, and that's what I mean, or similar outcomes, very similar outcomes, for the same question. And we should kill the things like that. If you have a prospectus approved in one country, you have to be reapproved in another country in order to be available for the investors in the country, and various things like this, which I think it's still low-hanging fruit actually, because you have to speak only to the regulators and only. I understand that many countries, I think including my country, are very easily be touched, when anybody speak about the taxes. So from the outside point of view, you would think that this withholding tax harmonization would be the easiest, but I know that there are some politicians, they hear the word tax, that they are immediately, protecting their national interest, although they don't understand what is it withholding tax on the dividend, and that it's would really be profitable for everybody. So I think that would be more difficult, but the regulation situation probably is, for me, from a little bit knowledge of what is it about in Europe, is probably easier to get.
Thank you very much, Peter. I don't want to put words in your mouth, but I guess on the supervisory side, coherence and consistency a little bit among the practices, I guess that is.
Oh, absolutely. You worded it much better than me. Yes, I'd say same question, same answer for a really easy explanation, but not from one central body, because that would make it probably administratively more difficult and expensive. And I would say the best would be if all the regulation decisions on all Europe would go only in English, that they're accessible immediately by the other countries.
Same question, same answer. We will bring that to the panel after lunch because they will have a discussion around supervision. Excellent, Peter. And I turn then to Athanasios. Sorry, I'm sorry about pronunciation. Athanasios.
It means immortal in Greek. Okay. Well, I will say we need to focus on two different things. First one, it is infrastructure. Second is the financial product, the listed company itself. With respect to infrastructure,
I think it is important that we go to a harmonization of supervisor harmonization at a European level. Many supervisors mean different supervisory approach and interpretation of basic rules. Market abuse, different interpretation in various member states. Listed transfer of securities, different interpretation in a number of member states. So we need ESMA to be a single supervisor for cross-border transactions and for companies with a certain market capitalization and over. Second, we need a single order book. And in order to do that, we can use the example of the target to securities. So at central bank level and European Central Bank level, we can have something like not a new exchange, but a supranational meta exchange infrastructure where all internalizers, all exchanges, all investment fees feed their orders, or the order routing system is the same. In this way, we have a consolidated TEP. Okay. Third, in terms of financial products, we need to provide incentive for bigger companies and with greater free float. If we don't do that, we have the super infrastructure, but we don't have the products to offer. Okay. This means we need to revisit the takeover directive in terms of, because we cannot have a single market if we don't have a proper market for corporate control. Okay. And also we need to, and I'm finishing, we need to emphasize on the role of private equity, because this is the catalyst for better and more listings. It is an exit for them. So we need to see the rules for the distribution to retailers. This is national law right now. It's not harmonized. We need to introduce new types of regulations, like the UVICA regulation for green bonds, for green funds, tech funds, etc. And for all this, we need to focus on technology. And blockchain, artificial intelligence is there and will help us to provide for better regulation, better systems, better integration. Thank you.
Thank you. I think in general, the role of technology, absolutely, I think in all the developments going forward. The question is, I guess, then what, how we can make sure that the policy measures accompany also these technological changes. And by the way, the Commission was mentioning earlier the AI consultation in the financial sector that we are going to be doing shortly. Javier, your policy measure, your one policy measure.
Is that fair? I've heard many already. Eh? I need to say, Athanasios, we need to have a coffee, you and I, because I disagree with 80% of what you said. So it has to be a coffee with dessert, I think, probably. So it's a long debate.
A four-course lunch, I will suggest.
No, if I have to summarize what is really worrying me, and not honestly, I'm not worried about some of those things. What worries me is how the equity market in Europe can really develop. And we're always, we have this paradigm of looking to ourselves like infrastructure. So everything depends on the infrastructure, no? Whether we have one, we have two, three, whatever. And I think that is important, but we're missing the point. The point to me is, why do we have such a limited investment in equity? And the more we talk about ourselves, the worse. Because the real situation is that in a Spanish image, sorry for this, to grab the bull by the horns and not talk about the fishy stuff, is that we need to make the equity European market much more attractive than what it is today. That is the problem. When you talk to issuers, talking to issuers to me is humbling. Because all of a sudden, when you're dealing with the daily things, trading, clearing, post-trade, then all of a sudden you go to talk to your customers, and your customers don't have a clue on that. And they don't care. They trust us. Somebody talked about trust. They trust that we do the right things and we fulfill regulation. The question is, why they're not listing? Why are they not listing? Are we addressing that question here? No, we're not. Why SMEs take so long to come to exchange? Why? Why retailers are not investing? Why? Is it because of the clearing, because of the settlement, because of the trading? In my opinion, it's not. I totally buy your arguments on difficulties and cost of transaction for ETFs, but you wouldn't have an ETF if companies wouldn't be there. No? So we need to start for the raw material. The raw material is the issuers and the investors. And the issuers and investors are not providing with IPOs, we're not providing with volumes because we don't have the right incentives to be equity. For example, we talked about the DEBRA. So how long is it going to take us to equalize the tax incentive to be leverage in debt or leverage in equity? How long is this going to take? 30 years? 40 years? 100 years? It's very obvious that it's much better for P&L to do it in debt because obviously interest income is tax deductible. Okay, we know that. We've talked about it. There is even a draft. When is this going to be passed? Never? So why? I mean, what are we talking about? We're talking about retailers. Totally, I would like to be Swedish, by the way. I mean, it's absolutely what we have proposed in Spain is exactly to do something like that or what we have in the US, which is, do we really want retailers to be in the market? Are we doing anything for that? We're doing nothing. Nothing at all. That's not only a question, which I buy, of granting the opportunities that are coming different European exchanges for them to invest and make it seamless. I totally buy that. But the question is, how on earth is anybody going to invest in equity if the tax authorities are greedy enough to take every single euro that falls out of your wallet into their hands? Are you asking people to save in equities? They will never do it. They will never do it unless we take all tax authorities in Europe and discuss why we don't have retail investment in Europe. And I tell you, my humble opinion, if we provide with an element, an instrument like this, like the American one or the Swedish one, and we tell them, look, if you save in equity, you have a parachute of tax protection until you dispose of them or until you retire, then we might see a result. But what is this thing of capital markets? You know, all the time talking about retailers, and we do nothing. There's nothing on the table to solve it, nothing at all. We've done a lot, retail investment. I know, I totally buy that. I don't want to be unfair. There's a lot of regulation that has been passed in terms of transparency and better regulation. I totally buy that. But if we want to really reinvigorate the buy side, nothing is being done. What's happening to pension funds? Everything else, we talked about it. What is on the table, actually? And we're talking about consolidation, and we're missing the point. The point is that the raw material, the issuers, and the investors are not finding the right incentives in the European market. And unless we put them to work, and we put the right focus of the next Commission into those topics, solvency rule, taxation, etc., we will never get it. We just will never get it. We'll be here in 5 years talking about exactly the same topic, So either we put the focus into what is really a game changer in the European market, or we'll never get it, honestly. Sorry, I have a very strong view on this. I get thank you.
It's very good. We like strong views, and I also promised the audience that there would be some disagreement on the panel. No, I mean, jokes apart, I think if we look at what the European leaders said in the conclusion in April on CMU, the importance of CMU, but also being quite specific on the various areas that had been identified, which, by the way, I think is similar to what the finance minister have discussed as well. Insolvency, retail participation, taxation, it is all there. But then, of course, now the issue will be to really make it happen in practice, as you say. Gunjan, your recommendation.
Yeah, I think I'm going to focus on market structure, and it will touch upon some of what's already been mentioned. But for me, I think the opportunity to, and I'll leverage what Johan shared earlier, to get to a place where there's greater interoperability, perhaps above even consolidation, I think is key. And there are tremendous opportunities to strengthen and improve the market structure of the capital markets in this region. The specifics I'll share around that is, look at the US. And again, I think it's important just to look at what's happening globally, and we shouldn't have our heads in the sands like ostriches. So I just mention it for the purposes of an example, because there could be a helpful lesson for us. There are 4 major exchanges that are in the US. Yet they have managed to stitch that data together, but still have tremendous competition that benefits the end investor. So for me, I'm thinking, how do we bring elements of that to Europe? And if there is greater interoperability, to really give and not fragment the insights and information for investors, but to really harness and perhaps find a way to stitch that together, hypothetically, where there might be one listing, but the opportunity for investors to trade in multiple different places over different exchanges. I'm curious whether technology could help evolve the market structure across the landscape over here to benefit the investor experience. Investors will go where they see the greatest benefit for them to execute, and they need the right information to do that. So I'm going to touch upon that theme, and I'll also draw upon another one that was briefly touched upon, incentives. I'm looking at incentives that might exist for market makers, for the liquidity providers on exchange to really, again, harness the best experience for the end investor. There are some of the most aggressive market-making incentive programs that I've seen actually on Asian exchanges and on US exchanges, and I think that's an area that Europe has a real opportunity to look at as well. Not just lead market-making incentive programs, but what about secondary market-making programs as well, to bring on a secondary market maker and really start to entice and do a double click there. I think those are some of the market structure opportunities that exist to be able to strengthen further.
Thank you. And then the final word here to you before the questions from the audience to you, Johan.
Thank you. It's very hard to single out one measure. I think it's really about a multitude of measures. A lot of this is about plumbing. And as if anyone's lived in an old house, it's extremely important to have good plumbing. But that said, if I single one thing out, I think it would be the demand side, to really try to make concerted efforts across Europe to boost demand from retail investors for stocks. And I think that's an attractive way forward, because you really kill two birds with one stone. The first is that we should believe that it's good for households in the long run to have exposure to risky assets in their portfolios. And there's a lot of evidence across Europe of that not being the case. So there's something to address there. It might mean more risk in the short run, but actually improved economic security in the long run and at old age. The other bird being killed with the same stone is to try to promote this development that we've been talking about throughout this session. I think we shouldn't underestimate the power, the innovative power of all the firms involved here. And really, there has been a lot of innovation going on that has to do with consolidation, but also has to do with interoperability, like you were just saying. And if retail investors, to a greater extent, are demanding these services, or the intermediaries acting on their behalf, that's also going to put pressure on the firms. It's going to put pressure on the regulators and the legislators, and that's going to hopefully help to bring these things forward. So that's the one that I would push for. I think it's, apart from the ISK and the tax treatment and keeping it simple, I think it's also really important to think about the pension system and about the funded pillars there, because if your government or your employer is not sending a signal that you should trust the stock market for your long run savings, then what's that saying, right? So that's a good place to start, I think. Second, if you're thinking about products like the ASK, let me just repeat and emphasize that it's really a very simple and very cheap product in a sense, or a wrapper. And it doesn't have a lock-in based on age. So you're not risking an offset against liquid buffers. Households need to have liquid buffers if they suddenly face unemployment or a severe recession. So these savings are not locked in the way they would be in a pension product. In addition, there are no constraints on whether these are securities that are issued in, say, Sweden, or for that matter, the EU. And I mention that because of some of the things that have been discussed already under the banner of this savings and investment union. Some of the suggestions put forward would be to sort of try to encourage these products to contain securities issued within the EU. Home bias among retail investors is an extremely robust empirical finding. You will have a massive overrepresentation of domestic and EU securities in these things anyway. I think to actually go in there as a regulator or legislator and really sort of damage the risk-reward trade-off here also sends a very bad signal. So I think be wary of that. That would be another piece of advice linked to that. Thank you.
Thank you very much. I'm not going to attempt to summarize the panel. I think it's been very, very rich and super interesting. I was, I mean, Johan started by his first introduction by saying, you know, the glass, the famous glass, which is half full or half empty. I got a little bit the sense on this panel that the glass maybe is more half empty than half full, but let's stay positive. It is half full, and we have a lot of measures identified, actions identified that need to go into our famous glass. We have, I know you're all looking forward to lunch, but we have a couple of minutes left, so we will take a few questions from the audience. And yes, I see a lot of hands going up already. I'll start with the lady here in the middle, and can you please introduce yourselves?
Thank you very much. Jacqueline Mills from the Association for Financial Markets in Europe. Very interesting panel, lots of diverse views. I think there might have been one area of consensus towards the end, and that's the question I'd like to ask. But first, I'd like to sort of stress a few figures on the liquidity landscape. And it still puzzles me that there are these ongoing debates about where liquidity is and how much of it is addressable. I think that might be one of the first issues that could reasonably be looked at. And we know that ESMA and others are making efforts to sort of standardize these approaches, but it still seems strange that we can't really understand the liquidity landscape in the EU, or at least have a common understanding of that. And when we look at data which tries to identify where addressable liquidity is, the shares of on-venue and off-venue trading are more or less stable over time, and on-venue trading in the EU is about 70%. And systematic internalizers are providing a function that exchanges can't, because systematic internalizers are putting their capital at risk to enable trading, whereas as exchanges are providing that sort of forum for matching interests to come together. So I think the two are important complements instead of substitutes. And that sort of brings me to the point that I think fragmentation is very interesting to look at when it comes to looking at the differences along national lines, rather than in terms of the choices of trading modalities that are made available for investors and which are very helpful and useful for investors. And so I'm curious to understand how panelists think that we can stitch together the data, I think, as Gurjan said, and encourage interoperability while allowing that competition in practice. So the concept, I think, is there, and I think the panel more or less agreed on that. But in practice, what are the actions to take to sort of move forward with that? Thank you. Sorry for the rather long question.
Javier, do you want to, who wants to come in on this? Ola, Gurjan, please.
Yeah, I can start, and perhaps others want to chime in. So look, I'm going to go to the point that Peter made. You know, I absolutely wish we did have the transparency of a real-time data feed that was showing the real-time price transparency with the consolidated tape 5 years ago, but I will say better late than never. And if we're looking forward, so let's think glass half full rather than half empty, we're certainly going to benefit all investors of the future once that does come to fruition in the marketplace. And I think that goes a long way to helping with the interoperability, because it provides that transparency to all investor types, hopefully of all of the venues coming to the table, where that will then exist to show where is execution, where is the level of execution that is occurring from, you know, one security, whatever the underlying might be. I think that's crucially important. The second point I'll make is you spoke about not being substitutes on exchange or off exchange venues, but perhaps complements. I would just ask us to question, how does even the substitute effect, if we go with that theory that you'd mentioned, benefit the end investor? And I'm talking about the retail investor that will not have neither the systems nor perhaps the right level of information to understand what's going on in the off-exchange venues that they might need to be informed about to make their own decisions of execution. And the US market, again, just to kind of use that one, they've clearly managed to really bring volume on exchange to a greater extent than perhaps other parts of the world. And again, I touched upon some of the market-making incentive schemes they are bringing those same liquidity providers who are putting their balance sheet and capital at risk to do the off-exchange trading onto exchange to be able to incentivize the trading to occur on that venue.
Thank you. Anyone else want to? And please, we keep it short. I want to take more.
Yeah, exactly. I fully sign this. I'm also going to be happy if on the future consolidated tape going to be finally all the data.
And frankly, this is what I proposed previously. I mean, as an infrastructure at ECB level, which will consolidate all data as a single order book. Everything will need to feed real time the information, whether it is a systemic internalizer or it is an exchange. We have the same step, price step. So I think this is feasible.
Okay, we take 2 more questions, and please keep your questions, 3, because 3 people are their hands up. So please keep your questions short, and we will try to do short replies as well. Should we go? I think I have Nicola in the back first, but please, no, it's fine.
Pablo Portugal from Euroclear. Thank you very much for a lively panel. Maybe a couple observations on the question of consolidation of infrastructures, although I agree that this is not the only driver of the CMU, as has been pointed out. Clearly, if we look at the European landscape, there has been a degree of consolidation at group level among infrastructures and the groups represented. What we have is many legal entities, many national CSDs. So an interesting question to look at is, what prevents more mergers between CSDs, more consolidation, when it comes to the legal entities, For example, in the case of Ireland, there is no national CSD there, and that was driven by a big event, which was Brexit. So the Irish securities were onboarded into a European infrastructure, another infrastructure. And so for that to happen, the member state had to agree to that. It's a question, to get the national agreement, and the Irish market had to agree to that. So FMIs can only do as much as their ecosystem allows them to do. So I think in looking at this question, in the future, we also need to, maybe that's a question for the state secretary as well, look at what are member states prepared to agree to when it comes to Europeanization of infrastructures. And this involves questions of national sovereignty, of local ecosystems, etc. As a final point, I would very much echo the remarks around, aside from consolidation, we need to ensure that we achieve true market integration via interoperability, open access, competition between different infrastructures. In the CSD space, for example, we have a passporting regime that has been recently simplified, but it has been very painful to make it work effectively, to obtain a passport. So the Commission and the co-legislators have simplified it in the CSDR refit. We will need to see how that works in practice, but we need to really look at removing those barriers to true competition in the single market, and maybe that can be a trigger towards further consolidation.
Thank you. I think in the interest of time, we're going to group the questions, and please do keep your questions short. We can continue the conversations during the lunch break later. Nicola?
Nicolas Veron at Bruegel and Peterson Institute for International Economics. So a brief question indeed. Several of you referred to interoperability. Apparently the current supervisory architecture is unable to deliver that. So what degree of supervisory integration would be necessary? That's probably more question to Johan and to Mrs. Chauhan. For interoperability to be workable. Thank you.
And we take the final question here.
Thank you. Rafael Plata from the European Association of Clearinghouses. I was very interesting to hear the comments by Johan about the fact that this is not really about consolidation. There's other issues that really drive capital markets. And I was astonished really with the figures that you mentioned. So you just run past through them, but if I got them correctly, the ISK has unlocked about 1/3, equal to an amount equal to about 1/3 of the GDP in Sweden. Transposing that into EU numbers, we would be talking about 5 trillion euros if we did that, 1/3 of the EU GDP. I would like to hear, perhaps from Johan and from the others, would you agree that the key for the ISK success would be, I think you mentioned simplicity and taxation, as Javier was saying, perhaps we're missing the points of taxation. And to you, Paulina, I don't know if you can answer questions, but in relation to taxation, similar to the question that I asked to Commissioner before, would you think that DG FISMA can actually drive, I know it's not your remit, but could they actually drive some change into taxation that could be meaningful to capital markets? Thank you.
Thank you. Always happy to answer questions. I will let the panelists speak first. So we have the question around CSD consolidation. We have the question around interoperability and what level of supervision we would need to achieve that interoperability, and the what are the key factors for the success of the ISK, which I think Johan will have to reply to. So I will maybe start with you, Johan, and then the panelists, if you want to come in.
Thank you. Very good questions. Let me try to say something briefly on all three. First, the CSD question. No, I think we have the same perspective there. It would probably be a mistake to sort of force a drastic consolidation of CSDs without thinking about why we have the current landscape. It seems, and I think this point has been made previously today, to be very much about having still a lot of national legal frameworks that, in a sense, makes it rational to have CSDs at the local level. From a single market perspective, perhaps some of those differences in legal frameworks in the long run won't necessarily have to be there. My advice to the Commission in that case will be to sort of try to think about a very realistic timeline for that. We're talking about very, very difficult reforms when it comes to company law and solvency law. I'm an economist, not a legal expert, but I realize this is a very daunting task, and it certainly goes beyond, I think, a single cycle in Brussels. So you really have to think very far ahead and think what are the logical steps for that kind of work. The question of 28th regime, if that is a good route or not, I think that's a very difficult question. It's also been mentioned maybe a coalition of the willing. Well, that's interesting if there really is a coalition of the willing. If so, please make yourselves known. That could be a good idea. Second, moving on to Nicolas Veron's question about the supervision. I think it's pretty clear that in this area, because there has been a lot of consolidation at the group level, so you have these parent companies that are active in a number of jurisdictions, and they're interacting a lot with different systems for different supervisory practices, some difference in regulations, but also different reporting platforms and standards and so on. I think to the extent that that can converge, maybe reporting at the central level should also be considered. To think about what the role for ESMA should be in all this, and in that case, what is required of ESMA to take a bigger role in this, in that case. That's a very interesting discussion to have. And it doesn't have to be about centralizing supervision. It could also just be about making those borders a little bit less of a salient threshold and less of a cost. Finally, then to talk about the ISK a bit more, very happy to do that. I think, yes, those numbers were correct. I think really four things are important if you want to design something like the ISK. And the first is the simplicity. So with the conventional method of taxing savings, which is also still in place, by the way, remember, so this is an optional tax treatment. You're taxed not only on distributions like dividends and coupons, you're also taxed on realized capital gains. And to do that, you have to keep track of what you bought the shares for and what you sold them for. You might have splits, you might have mergers. This is actually really difficult for a lot of retail investors to do. So getting rid of that paperwork was in itself a big rationale for introducing the product, because also our tax authority knew that so many people just made human mistakes trying to calculate that. I would also stress the no fee or low fee element. You do not want this to be a sort of insurance style product with very little insurance in it that then adds another 50 or 100 basis points of fees. You want to keep that very close to zero or at zero. And finally, just to repeat that point, no lock-ins. There are no requirements on these issuers being in Sweden or in the EU. There is no lock-in in terms of the time that your money has to be there. It is, of course, an ideal product for long-term savings, but you can also use it as a liquid buffer. With regards to the tax treatment, it's basically the risk-free rate, the current rate on long government bonds, plus 1%. That's the standard rate. So rather than your actual returns, that's the sort of standard return that you're taxed at. The risk-free rate plus 1%. everyone in here probably has their own estimate of the equity premium, but you can relate that estimate to that, and you can think about which of your savings you would like to have in this account and whether it's attractive or not. Okay, thank you.
Thank you very much. Anyone else wants to come in on any or all of these three questions? Javier?
Very quickly, on the CSD consolidation, you have a limited experience. You have one CSD. You come from Euroclear. How many CSDs do you operate? Maybe the question is for you in the sense of why haven't you, as Euroclear, gone for a consolidation of all the CSDs that you manage in Europe? The Irish example, I think, is good. But again, I think there are several elements in the case of everything that has to do with the law, with corporate law, obviously when you are a company from whichever country, your natural choice is to go to your own notary. The notary you have near you, to say, hey, I want to list in the market. This is what are the conditions? What are my obligations? So on and so forth. So there is a natural element into going to your CSD. Can you merge them? It is possible, but honestly, it's also the same thing. Is to allow, if we go for a single CSD like we have in the US, we create a national monopoly, a European monopoly. Is this what we want? Maybe not. In this moment, we have a big competition among trading venues and CSDs on listings. You probably have noticed. All of us are trying to go to talk to the different companies to list in our countries. Is that better or worse than having a single CSD? I don't know. I'm not trying to make a point here of this is the perfect system, but there is a balance here of competition. That's why I said fragmentation, competition. What do we really want in Europe in this? And that's what you said, Pauline, on the balance. And finally, on interoperability and what was mentioned on supervision. I have one experience on interoperability, which is the interoperability we hold today in the Swiss clearing house, XClear, with LCH and CBOE. It works. It works very well. But there is no common supervision. I'm a Basque, so I'm not a centralist. Sorry, it's impossible that I am a centralist, that I believe that everything has to be in one place. It's against my DNA. Do we really want to? It doesn't mean football team even. Sorry about that. It has a reason. I'll tell you later. The thing is that do we really want to have a common supervision for everything that stems from Brussels or from Paris, wherever it is, for everything? Is that what we really want? Is that the best way to bring competition, make an agile market? Is this really what we want? But then let's discuss it, because if we try to talk about things in a way that is not disguised, but kind of the implicit debate is, what do we want? If we want centralized things, as a principle, I'm against. That this is better than decentralized, I'm against. I have experiences with products that have gone through the centralization of supervision in this moment, which is not really good. It's not agile, it's not time to market. So, I mean, having a single one might not be the best solution always. And again, I live through a daily experience of not having a single supervisor for an interoperability arrangement in clearing. By the way, interoperability, again, like fragmentation, is a big word. So we will have to talk about interoperability in access to markets, in trading, in clearing. So it's not just one thing. It's a very broad concept that each one of the pieces have different features that we need to talk about. Sorry, super long answer. I apologize.
Usually I do agree with 95% what Commissioner McGuinness was saying. But today, and it was a question about this consolidation thing and how we should achieve capital market union, she mentioned one sentence: preservation is not a progress. I tend to disagree. That was answer to your question. I think actually there is a value in local or regional ecosystems which are bringing the SMEs to the market, because I promise to keep it short. I have here the answer just from last week from the regional bank, not a small Czech one, a regional bank, who basically literally wrote me that deals under 200 million are not interesting and that I should go to the small brokers. If we want these small brokers to exist, they have to trade also the blue chips on the market. So if we are in the situation that there will be intense cherry picking due to some regulation and maybe some thoughts, let's quickly consolidate it, we will kill the smaller markets. They will never become bigger. And the banks from Wall Street are not flying to the regions. They are flying only to the capitals, and when the deal is 2 billion euro plus.
Just 30 seconds with respect to the CSD. I think two proposals. I do agree with all the reasons behind this. First, we need to agree on the prima rule. We don't have private international law rule regarding these things at European level. And second, we could potentially extend the scope of financial collateral directive into other forms, confiscation, or covering also retailers, etc., etc., etc. So I think it's very important. With respect to, I forgot, what was the third question?
The Swedish pension.
Yeah. We need to look into the perspective of what are the tax benefits for other countries. For example, in Greece, for retailers with participation of less than 0.5%, there is no tax on gains from listed securities, and the fee on and the tax on the distributions is only 5%. So this is not necessarily translated to a huge benefit for all member states. Maybe if you want, you can redomicile in Greece.
And very briefly, since I got a question as well, I think the Commissioner answered to the taxation question. Yes, of course, there could be a role for the EU. Or the recent agreement on the withholding tax proposal, of course, shows that EU action in this area is possible. At the same time, of course, there is a national role when it comes to how taxation systems are set up. I am aware that we ran over a lot, and I will never ever be allowed to moderate the panel in the ECB again. I apologize for that, but I do think that this was really interesting. Please join me in applause for our brilliant panel. And I think we are breaking for lunch now. Many thanks.
everyone, and welcome to this panel on single EU financial market supervision. Today we will discuss the different possible approach to and benefit of single supervision of EU capital markets, which typically refer to centralized supervision by an EU-level authority across all the EU member states. To recap, the debate about single supervision stems from the observation that market participants operating across EU borders currently face not only different rule books and multiple supervision, but also potential inconsistency implementation of otherwise similar rules. This complex supervision landscape contributes to the persistent market fragmentation we see today. As we know, ESMA is doing extensive work to promote the convergence of supervisory practices through guidelines, peer review, Q&As, and other tools. And we have Verena and her colleague to thank for considerable progress in this respect. Still, we acknowledge that ESMA powers and resources are limited. Single supervision could promote the consistent implementation of rules, reduce regulatory complexity, and contribute to a level playing field in the EU capital markets. A single supervisor could also be better positioned to monitor, assess, and act on possible cross-border risks. Convergence, integration, or even centralization in supervision are, therefore, key topics in the current CMU debate, alongside the regulatory harmonization and the consolidation of the trading and post-trading landscape, a topic that was extensively discussed this morning. The momentum to address the currently fragmented supervisory landscape seems to be building. Recently, Eurogroup, ESMA, and the ECB Governing Council have called for action on this key issue in the next legislative cycle, albeit with varying degree of ambition that reflect the political hurdles that remain to be overcome. In principle, different approaches to single supervision are possible, and I look forward to hearing the views of our panelists today on this topic. In this CMU debate so far, I have heard views in favor of a centralized authority, possibly ESMA, a view that we largely share here at the ECB, which could supervise key capital market actors similar to the approach that already exists for banking supervision or competition policy. However, a range of different views has emerged from seeking mere improvement to the current approach aiming at convergence of national supervisory practices, changes in the governance of ESMA, an opt-in for firms to choose EU-level supervision on a voluntary basis, or a two-speed approach, that is a centralized supervision among a coalition of willing member states. Therefore, there could be hardly a better time just after the EU election and before the next Commission takes office to discuss the benefit of common capital market intervention and the various approaches that could lead us there. On the panel today to discuss this important topic, we have 5 experts with a range of high relevant expertise coming from the public sector, the market, and the civil society. Let me introduce them, starting from my right, going all the way down the panel. We have first Nicolas Veron with us. Nicolas is a senior fellow at the Peterson Institute and, of course, co-founder and senior fellow at Bruegel. He recently published an analysis on the state of play of the CMU, including concrete, far-reaching proposal on supervision integration. Next to him, we have Verena, and she's the chair of the European Security and Market Authority. Before joining ESMA, as a first executive director of it at its inception, she held various senior positions in the UK financial service authorities. Next to her, we have Alexandra Monchinska. Did I get right? Good. I exercised all morning, so that was not by chance. Managing Director of the European Federation of Investor and Financial Services User, better known as Better Finance. Then we have Pat Lardner, who is the Chief Executive to the Irish Fund Industry Association, the representative body of the International Investment Fund community in Ireland. And last but not least, we have Stéphane Bouzna, CEO and Chairman of the Managing Director Board of Euronext, the company responsible for running exchanges in Paris, London, Amsterdam, among others. So before getting to the specific question, just some housekeeping. So we will have 3 rounds of questions. First round of questions, the panelists have 5 minutes to answer. In the second and third round, they have just 3 minutes, because this should leave us some room to ask, to have some questions from the audience, both those that are present here and online. So let's jump into the very first round of questions. So before we delve into a single capital market supervisor, how the single market supervisor could look like and how we get there, let's take a step back and look at why we are discussing this in the first place. So I would like to ask to the panelists a generic question and then a specific question to each of them. So the most general question is, what do you think is missing right now in terms of supervisory convergence and integration, and what would be the benefit? What would the benefit of a single supervisor be? Let me start with Verena. What are the limitations ESMA currently face in carrying out its mandate, and what benefit would there be to expand ESMA power? So Verena, you have 5 minutes.
Thank you very much.
I'll keep the time.
Thank you, Piero, and thank you very much for having me here today. It's great to actually have a conference where we focus specifically on this topic. It's clearly very topical, it's more and more discussed. But let me, as you suggested, maybe take a step back first and think where we've come from. So when ESMA was first created over a decade ago, we really, in the beginning, focused a lot on making sure that we had consistent understanding of the rule book. So we worked a lot on actually creating common rules, common guidance, common views of what actually the rules mean, and then try to implement that consistently. I think with time, we have seen that that only takes us so far. So we then said we need to move beyond that and more expand our supervisory convergence work. And as part of that, we've really looked at how is supervision actually conducted on the ground, and what in particular areas are the things where we still have divergence of how actually supervision is done in different national competent authorities. And the aim was to ultimately make supervision more efficient and more effective. So, and I think we've advanced quite a bit on that. We have certainly have now an expanded toolkit with the new ESMA regulation in 2019. We got some additional tools, such as union strategic supervisory priorities, where we basically focus all of our efforts as the national authorities on one particular risk or issue where we believe we need to really have a consolidated and common approach. We've also developed a number of more in-house tools, I would call them, where we basically went beyond that and looked at, for example, voluntary colleges or common supervisory actions, where we basically, on a voluntary basis, get the NCAs together and say, look, we believe this is really a common issue where we need to all make sure that we focus on and we look at. And so that has proven actually quite effective, and has certainly hugely enhanced the cooperation and collaborative effort amongst the NCAs. I think when it comes to the constraints that are there, the reality is that in the end, all of that convergence effort relies on the ability and the willingness of individual national competent authorities to join in that common undertaking, which in the vast majority of cases they very much want. But the reality is also they always have competing national demands on what might be more important in their country. And therefore, it is an additional effort to make sure you have the right capacity and resources to look at the European-wide risks in a consolidated way. So I think it's clear that extensive convergence work is a real challenge to deliver on, both for national competent authorities and for ESMA, just in terms of capacity and ability. I think the other thing that we need to recognize is that there are limits on how far convergence work can go. We rely ultimately on the goodwill and the abilities of the national competent authorities and their ability to operate on a timely and effective manner to take care of specific supervisory risks. And while we can push in that direction or there, the reality is it remains in the hands of the national authorities. And with that, there are different cultures, there are different approaches to how to deal with certain things, which will always mean that even if you have the best single rulebook, the outcome that you get in the end is hard to align really completely. And as you said, Piero, the reality is that we have challenges with increasing cross-border business. And how do we make sure that that interconnected cross-border business can be supervised in a way that is genuinely joint and a close cooperative way? And that's why ESMA, in its recent position paper on how to build an effective and attractive market, has very much focused also not just on thinking about what do we need as a single supervisor and in which areas potentially, but really also how can we, for the vast majority of areas where national supervision will stay, where it will remain at national level, how can we further drive the convergence efforts? And there it's about more joint supervisory work. It is about maybe giving some more central assistance through ESMA in data collection and analysis, whether that comes to having risk identifiers that can then help the supervisors to focus on the right issues at national level, or whether that is, for example, in common market surveillance efforts. All of that we need to continue to drive. The continued focus on convergence will be important, whatever we do on the wider framework for supervision. And maybe I stop here.
Thank you, perfect timing. So Alexandra, from the perspective of citizen and retail investor, what do you see as the current gap in supervision and where could a single supervisor help?
Thank you. First of all, thank you to the organizers for inviting a representative of retail investors and citizens to this discussion. In fact, maybe for those who are not familiar with Better Finance, we are a federation of member organizations. We have member organizations, most of the European member states, and their individual members are individual investors, so retail investors. Maybe because you asked us to take a step back, I would just take maybe even additional one step back, because for retail investors, extremely important to this discussion is the context. And of course, the idea of single supervisor comes not from nowhere. We would like simply to see the CMU progressing. It is not. For the last decade, the outcomes for retail investors are poor. We have seen recently some statements and reports that complain in a certain way about the situation in which retail investors do keep their savings on the bank accounts, they don't invest them. One of the reasons for that is, of course, value for money that we are not going to discuss here today. But of course, value for money that at the end of the day, the investors get is connected to how well the supervision of the financial entities is working. And we have done also a bit of research. I mean, Better Finance with our member organizations. And it's pretty clear from this research and also from the annual report that we publish on the real return of the long-term and pension savings, that the outcomes for consumers are not good. When it comes to the key gaps in the EU financial supervision, so we see many of those gaps. It's fragmentation of regulatory standards. It leads to inconsistencies in the application of financial regulation, and it is creating an uneven playing field. We have insufficient cross-border cooperation, so a lot is happening cross-border. Financial markets are increasingly interconnected, but there is no really a mechanism that would allow for a seamless cooperation between different national bodies. We have also complexity of regulatory environment, and this is also a problem for retail investors that would like to invest and understand also a little better how it works, and especially for those that would like to invest cross-border. And also we see gaps when it comes to enforcement of financial regulation and also the imposition of penalties. We have some member states where the national competent authorities are pretty vigorous, and others that are being criticized for not doing enough, or for example, imposing fines that are quite often the minimal fines that you could actually impose for some regulatory breaches. For retail investors, the problem is, of course, when you look for some emerging issues like crypto, when they also saw different approaches in different member states and quite diversified framework. When it comes to the greenwashing in financial services, because we also have seen different approaches in the member states and different, I would say, interest in tackling some of the issues that appeared. And we also had different scandals that have even more disposed and showed the supervisory failures. One of them is Wirecard, and here some of the academics also say that this example is in fact a textbook example for how and why a single supervisory authority would be better, and how in fact a supervisory authority that is the closest to the local market and should have the more insights was in fact not taking into account that much the interest of retail investors and investors in general, but rather protecting an entity that could have been seen as a national champion. So we see, of course, that those kind of gaps could be addressed by a single supervisor. And especially when you look at the detriment that this is causing to retail investors, some academics have been trying to quantify the adverse impact of these supervisory gaps on individual investors. And according to some, this inconsistent regulatory environment in the EU can increase the cost of investment product by up to 2% annually due to diverse inefficiencies. So we would see that definitely there is a space and a role for a single supervisory body to address those gaps, but only on the one condition: such a body would be really effective and efficient. And then we would say that this body could be able to really offer some solutions and address these gaps by providing a unified regulatory framework and some oversight mechanism. But I suppose that maybe we'll have time a bit later to go into details on how such body could look like.
Thank you. Perfect timing as well. So let's move to Stefan. Stefan, as a cross-border group of stock exchange, Euronext is advocating for EU-level supervision. What challenges does fragmented national supervision create for Euronext, and what benefit would a single supervisor brings for Euronext?
Thank you for your invitation. As you said, Euronext has a particular perspective, and on that particular point on single supervision, we change our mind. During the high-level forum initiated by the European Commission at the beginning of the previous cycle, we advocated a sort of convergence and upgrade the status quo, whatever, and we radically changed our mind over the past year or so for the following reason. Euronext comes with an history of a relatively smooth cooperation within supervisors. We are supervised by a college of supervisors that operate on a federal mode with a rotating chair, and we operate 7 regulated trading venues in Norway, in the Netherlands, in Belgium, in France, in Portugal, in Ireland, in Italy. We operate 4 CSDs in Portugal, in Italy, in Denmark, in Norway. We operate 1 clearinghouse in Italy, which has a European reach now, and we operate various MTFs all over Europe. And this college of supervisor works pretty well. The problem is that the single liquidity pool we operate, the single order book we operate, the single technology platform, which is, by the way, pretty large, because over the years, we have now average daily volumes of equity trading of 10 to 11 billion euro per day, which is twice the size of equity trading in London. We have aggregate market capitalizations of companies listed on Euronext market of about 7 trillion euro, which is again twice the size of the aggregate market capitalizations of companies listed in London. So it's a pretty large integrated European market. But even if it works okay, it's not optimal, and it doesn't converge. And just a parenthesis here, I just want to insist on the fact that we are talking a lot about framework, regulation, etc. But the core priority for all of us should be what Mr. Hernani mentioned earlier today, which is how to get more equity. And the real project should be mega, make equity great again. And that should be our priority, because really you can do whatever very nice dress. If you don't have the bride, I don't know how you can get to any marriage. So it's really, really important to focus on. Now, why is this situation today not optimal? Just because of fragmentation. In reality, you have 27 national supervisors, and in some countries you have a financial market. In some countries you have zero financial market. So the reality is that you have national authorities that don't know what they are talking about, because nothing is happening locally. I mean, the voice of Slovakia to discuss European fishing policy is important and interesting, as is the voice of the Czech Republic to discuss the European fishing policy. But the reality is that there are some countries that are so small and that are pure buyers of finance that they don't have the critical size to handle complex issues. And you have, on the other hand, countries that have very complex issues. So there is a reality which is a big gap in terms of understanding and relevance of the market, because finance is not distributed in an even manner. Second, you have a difference of culture. Some national regulators are obsessed by one single thing, which is the rule of law and applying only the relevant rules. Other national supervisors see their role as being the Ministry of Capital Markets and as steering and have somehow a delegated authority from the local ecosystem to shape and influence the development of capital markets. That's very different. In some NCAs, you have that the leaders are quasi-judges or very senior experts. In other NCAs, you have politically appointed people who have been defeated at the previous elections. So, because it doesn't matter at the end of the day, whether you have Mr. X or Mrs. B. So the reality is a fundamental fragmentation of knowledge mandate. So if you want to buy powerful integrated capital markets in Europe, we cannot live with that type of supervision. And again, there are very extremes on both sides. The second thing is that the reality is that the local supervisors do a one-size-fits-all job, because it's very different from the banking supervisions. The banking supervision supervise banks, but the capital market authorities supervise issuers, asset managers, market infrastructures, to mention the main clients of them. And this is a totally different world. So the discussion about what we need to integrate as supervision is not the same. I'm not suggesting that we should have a federal agency where every single supervision of every single company's compliance with relevant corporate law in terms of stock exchange law should be centralized. For sure, issuers' supervision should remain local, because it's so much embedded in corporate law, which is not federal, that there is no point in it. For asset managers, the debate is a bit more balanced, and clearly for the ones who have a multi-country operations, that should be federalized. And for sure, I believe, for market infrastructure, we need some form of consistency. And one last point at this level, we should not distinguish too quickly the need of single interpretation, because by one single body, and the need to proceed in parallel to single rule book. Because when rules are similar, they are different. And gold plating is consubstantial, is unavoidable when you go to the directive route. So the single rule is as important as the single application. So I do believe that we have no choice, at least for all the ones who are multi-country operators.
Thank you. Now let's move to our fourth speaker. But there has long been some resistance in Ireland to the idea of strengthening EU-level supervision in capital markets. Can you share your perspective on this issue with us? Thanks.
So thank you for the invitation to participate today. For those of you who don't know who Irish funds are, so we're the voice of the funds and asset management industry in Ireland. We have 150 member firms. The vision that we have is that we actually would be the premier location to enable global investing by having a reputation for trust, capability, and innovation, all of which will be important, I think, through the debate that we go through. I was a little surprised by the question, actually, because I'd say in Ireland, at both the citizens level and an institutional level, we've been amongst the strongest supporters of the EU. We have long been advocates of strong, effective, and converged regulation and the pivotal role that ESMA has played in that. Indeed, when we responded to the Commission's targeted consultation back in 2021, with precision, we were very clear as to the areas where we felt that ESMA has and continues to bring real value. That obviously works in conjunction with the very active program that our national competent authority has. And I'd say that, again, just reacting to the initial part of the question, then going back to the broader one, a level playing field is something that is absolutely welcomed by us because, one, it's important for CMU. Two, it's important for better choices for end investors and for their outcomes, as I think we've been talking about earlier on. And also, it offers a consistency of approach. So I think that the fact that we see there being a very strong benefit in an approach to regulation and to supervision, which is consistent, that doesn't automatically mean that we jump to that a single supervisor is necessarily the way to do it or the priority. Now, why would I say that? So the reason I'd say that is actually to come back to, well, what's the nature of the problem that we're trying to solve? And this conference is actually rooted in financial integration. So financial integration, I think, as the ECB itself has helpfully helped to outline, what does it mean? It actually means that you effectively get financial services are available under the same rules and the same conditions for all the countries that use the euro. So let's break that down into availability. So what is available at the moment to all citizens? So I would say in terms of solutions, we have very credible, very reputable solutions for end investors done via a European construct, UCITS, AIFs, and more recently LTIFs. And actually, we're going to talk about a number of issues, including competitiveness. And actually, these regimes, in particular UCITS, is an internationally recognized regime that brings capital from outside of the Union into the European Union as well. So I think we definitely have the solutions. Now, the question is whether or not those solutions are getting access and are getting to the end investor. I think that speaks more to conditions, which I'll come back to. In terms of the rules, well, we do have, and I know there will be different views, we actually have a very well-established set of rules. Same rules. We actually have very, very active revision of those rules in terms of making improvements. And we've also seen that the powers, as Verena has outlined, have been expanded, whether they be around remediation, preparation, or implementation. I do think in terms of rules, one of the things to impact integration is how do we look at the sequencing between rules being regulated and legislated for and then adopted, because that has an impact also on the end investor. In terms of conditions, I think ultimately this is where I would probably focus. And first condition that we have to have for financial integration is, do we have the capital? As Alexandra has said, we actually have the capital. We have, and we need to activate about 41% of the average European household balance sheet is sitting on deposit. So therefore, the question is, if we have the capital, what are the other conditions that need to be created? I think access is definitely one. I think we need to acknowledge the fact that we are starting from different cultural starting points. And I don't mean that at the level of the regulators. I mean that at the level of the populations. I came from Poland yesterday, where they are actually at a different stage of their journey. And actually how we make sure that we bring different groups of citizens along is going to be very important. And I think that there's also a piece around literacy, but this question, are we actually encouraging citizens to engage with financial services? Why should they invest? Because ultimately, in all the discussion that we're having about capital markets union, we're talking about other people's money. There has to be a strong feeling that both from policymakers, regulators, and industry, that there are very good reasons why they should do it. So in conclusion, I think that we can and should be focusing on the conditions as a priority. I absolutely would acknowledge that there is more that can be built on the already great work that ESMA and the national competent authorities are doing. But given the fact that we have many different things going on here, what exactly is the priority and what will yield the best and most enduring results? Thank you.
Thank you very much. Finally, we go to Nicholas. Nicholas, in your recent paper, you explained that a single rule book is not sufficient to make a single market and that supervisory architecture is crucial. Can you elaborate on what you see as the key benefit criteria and success of a single supervisor compared with multiple at the current setup?
Well, first, thanks a lot to the European Central Bank and the European Commission for having me here. It's very inspiring for me to speak here about supervisory integration in capital markets and what I view as a sanctuary of integrated supervision in general, because it's still the home of European banking supervision until moving to the other side of the street next year. I need to make a few disclosures. I'm an independent non-executive director of the trade repository of DTCC, which includes an entity which is supervised by ESMA. I'm not speaking today in that capacity, let me be very clear, and I don't view it as a conflict of interest. I'm also a member of the Scientific Council of Better Finance, but that's not a conflict either. Some of what I will say will overlap with some of what has already been said. I'll try to minimize that. So first thing I want to say is that we're talking about the shortcomings of failures, but a lot has been achieved. I have a vivid recollection of a comment made by Fabrice de Marigny. The old-timers will remember him as the Secretary General of the Committee of European Securities Regulators, a predecessor of ESMA, and he was instrumental in what was called, I think, the Himalaya Report, because it looked like it would be very difficult to achieve in the 2000s. And when the legislation establishing ESMA was published, we invited him at Bruegel to comment on the legislation. And I remember him really vividly. He said, "It's a dream come true." So he felt the Himalaya had been conquered. It was kind of maybe not the end of the road, but basically the real deal. Now we view it differently because, as you said, there has been a lot of learning along the way, but I think we should remember this is part of a longer journey. Having said that, after 10 years of Capital Markets Union being coined by Jean-Claude Juncker in July 2014, we did indeed observe, as you just said, that regulatory harmonization isn't enough. And I won't elaborate for a very long time on this, but I think a good illustration was given by Mr. Koblitz earlier today. He said, you know, you get a prospectus authorization or an issuing authorization in one member state, and it's not recognized in another. Is that in line with the text of the legislation? Probably not. Does the European Commission open an infringement proceeding? Probably not. So this is too much at a low level under the radar for this to become an issue for heads of state and government or even legislators. But for market participants, it's their daily life. And you can say that across a range of authorization procedures and enforcement mechanisms and all the things that securities authorities do. So basically, the obstacles are hidden. They're not hidden in plain sight. They're hidden in the experience of market participants, but market participants, for obvious reasons, also don't have an incentive to go very public about meeting those problems. And therefore, I think this explains why supervisory integration would be catalytic and why reformers really need to focus on this issue if they want to achieve something in comparison to the kind of scattershot approach we have seen to capital markets union in the last 10 years. So the point here is that all these activities are regulated and supervised for a reason. I'm not advocating deregulation. but supervision shapes markets. Supervision shapes markets. If you have fragmented supervision, you will have fragmented markets. So what are the criteria for success? I think, supervisory effectiveness is kind of a vague notion, but it captures what we want to see. We want this supervision to be effective. We want a level playing field, of course. We want them to be independent. We want them to have resources in order to be able to fulfill their mission. We also want to minimize the administrative, bureaucratic overlap with the NCAs, which means, by the way, that in some areas the transfer has to be pretty comprehensive. Rating agencies or trade repositories is a good example. This was a blank slate. There was nothing before it was introduced, and therefore ESMA does everything. The NCAs are not involved at all. So that works in terms of minimizing bureaucratic, burden. But for market segments where you have an established infrastructure, of course, it's more difficult. I will add one thing, and I'll stop there on what we want from an integrated supervisor. We wanted to understand the markets. We wanted to have connectivity with the markets without being captured by market participants. And we'll come back to this, I think, later in this debate, because I think this has very important implications in the design of a successful integrated capital market supervisor for Europe. Thank you.
Thank you. With this, we have concluded the first round of questions. Now we move to the second round. We will have one question for each panelist, and we will focus on the scope of supervised entities. I remind that you guys have 3 minutes to answer to the question, and I hope you will be disciplined as you have been so far, so that we can have some time for questions from the public. So, a recent statement, papers, and report on CMU have highlighted very different level of ambition and ideas about which entities should be included in the scope of supervision. Question for Verena. In its recent report on Capital Market Union, ESMA proposed evaluating whether specific areas of EU capital markets may benefit from EU supervision based on a criteria such as cross-border or pan-European dimension. Would you see the single supervisory mechanism as a possible model for capital market supervision where an EU-level authority would be responsible for the supervision of systemic cross-border actors? Or are you considering other models such as that of competing policy, which Benoît Cœuré recently suggested could inspire capital market supervision? Back to you, 3 minutes.
Thank you very much. And it's a big question for 3 minutes, but I'll do my best. I think the success of the SSM is clearly an example that we should look at. At the same time, I also believe that we need to think about what capital markets actually need. And I very much share what Stéphane said. I think we should remember that capital market supervision is, however, different from banking supervision. So I think we need to look what is the right model for the specific cases that we are looking at. And clearly, there's no one model that necessarily might even work for the whole of the capital market sector. Nicola was referring to it. Even for the mandates that ESMA currently has direct supervisory responsibilities for, we actually have slightly different models. In some cases, it's basically grown out of a completely blank sheet where we are directly supervising firms exclusively. NCAs have no further supervisory powers. Then there are other mandates where it is actually shared responsibility. So, for example, when it comes to data reporting service providers, where some, the bigger ones, are supervised at ESMA level, the smaller local ones at local level. Then we have others where we have a complementary role with the national competent authorities. So, for example, when it comes to trade repositories and the reporting entities that report into the trade repositories. So we have really different kind of setups, and I think we need to remember that diversity to find the right and most efficient and effective way of actually bringing the supervision together. And there have been clearly different debates. You mentioned it, Piero, different ideas put forward. I think from my perspective, And what we put into the ESMA position paper was very much to focus first of all, which are the areas where it would make sense. And then let's look at what would be the right model to do so. And the criteria for where it would make sense clearly is based on significant pan-European business. That's clearly where it is most efficient and most effective to move to that level. And I think in that case, what we put as examples were market infrastructures, post-trading or exchanges. We also proposed potentially crypto asset service providers, where actually at the moment we are building 27 times supervisory regimes in each country for a completely new set of market players. Seems not very efficient to my mind. So I think we could have done that better maybe. And then I think, as I said previously, for the vast majority of areas, I would still see national supervisors very much in the lead and working with ESMA and driving forward convergence on that national supervision and making sure we try to do things even more effectively together.
Thank you. So let's move to Nicolas. Nicolas, you have argued that the areas of market infrastructure and the reporting requirement are those that should be most urgently placed under the centralized supervision, while investment fund and prospectuses could be left for a future stage. Can you explain what considerations supported this prioritization and why did you come to this conclusion?
Well, I'll try, but actually there is a sequencing point that to me is much more important than that. And this is the fact, and this is absolutely not a judgment on the excellent work that Verena and her colleagues are doing at ESMA. But I think before expanding the responsibilities of ESMA, I think ESMA needs significant reform because it has not been designed to be an independent supervisor. And I think irrespective of the quality of the staff, irrespective of the quality of the work, there are fundamental obstacles to supervisory effectiveness of ESMA as a supervisor, as long as its build-up, its governance, its funding, its design are not significantly reformed. Let me make it very clear that I'm not speaking in my capacity as an independent director of a supervised entity here, completely different approach, but only as an external observer. So ESMA needs a new governance. It needs a new funding model. Fortunately, there is a model for that. If you look at what the European Union has just decided for the EU Anti-Money Laundering Authority, for which the legislation has just been finally approved, it may even be published, and it will be implemented in the next few months. I think this is a perfect blueprint for what we need at ESMA. So we don't need to reinvent something here. We have a blueprint which is based on European experience of, the single resolution board, the single supervisory mechanism, competition policy, what have you. And it can be transposed to what we need for capital market supervision. By the way, I don't think you need that immediately for insurance. The EBA, of course, is in a different space. So really focus on ESMA. Now, having said that, and I will still answer your question, why did I single out market infrastructure and corporate reporting or requirements? Because I think they're very simple to explain in terms of subsidiarity. And here I can only, on market infrastructure, expand on what Stéphane said earlier in this panel. But I think if you think of critical significance, including for financial stability purposes, by the way, if you think in terms of interoperability, which was mentioned this morning, and in the case of reporting requirements, very simply, if you think of comparability, which is the basic reason we have those requirements, because we want to be able to compare from one firm to another, irrespective of the country, it's very easy to understand why supervision of these matters need to be integrated. Thank you.
So let's go back again to Stéphane. What would be your perspective on a model where largest trading venues, including Euronext, would be subject to EU-wide single supervisor, while smaller national exchange would remain under national supervision? would you then be concerned that national supervisor would have additional reason to create obstacles to consolidation? You kind of answered to this the previous round, but then you have a chance to.
No, but let me be maybe more specific, and a sort of benchmark analysis with the banking supervision is useful. Just like in the banking supervision, making a difference between what is systemic in the banking supervision, what is pan-European in terms of reach or action, in our case, basically where consistency is needed, is one key metric. So if a local market infrastructure, which is purely local, decides that what is good for them is to be super connected with local specificities, why not? But for any market infrastructure that is operating in various countries, irrespective as to whether it's a bottom-up construct as our system where we are aggregating several exchanges that are bottom-up consolidation, or whether it's a top-down project like CBOE, which is incorporated in one single country in the Netherlands, but operating across Europe. I mean, we believe that consistency of supervision to create a proper level playing field is important. So it's similar to the notion of systemic, non-systemic being relevant at the European level, or I wouldn't say relevant, and then everyone would choose. Second difference, I covered it clearly by nature. Some activities like the supervision and regulation of issuers would have, in my view, to remain local. One last comment about where the banking supervision could be an option. Clearly, the governance of ESMA today is inspired by the fact that it's a talking body. It's a body that produces level 2 or level 3 pieces of regulations. It's a coordination body. It's a peer group, but it's not effective in terms of supervising large entities. In this respect, the governance model of the ECB and the SSM is a relevant one. We need to have around the table an executive board which is much more compact, which takes decision, and a consulting body which is relevant but only for non-executive decision, because we can't have the fiction of some national competent authority feeling having a say in decision whether or not they have a financial market or not, and whether they understand the issues. I mean, I remember very precisely the debates during the COVID crisis on the ban on short selling. There was a fundamental intellectual debate as to whether or not short selling on equity should be banned. Some countries felt that it had to be banned because it was good for issuers. Others said no, because intellectually we believe that it's bad for markets, and that even short selling is part of a fundamental investment decision. And in any event, banning short selling is bad for investors. So ultimately, there was a debate between the ones who thought it was what is good for investors, what is good for issuers. That's okay. But there were many other national competent authority who had no clue about what's all about. And we need to have a situation where fundamental issues in crisis times can be solved. But in this particular case, the view of within ESMA didn't make any sense because it was a national decision anyway. But we need to find a way to have a compact decision making similar to the ECB one, which is not inconsistent with the fact that on a regular basis you have a consultation of all the relevant countries.
To Pat. So Pat, Christian Noyer recently published a report that was requested by the French Treasury, and this paper suggested that asset managers could submit themselves to the direct supervision by ESMA under an opt-in arrangement on a voluntary basis, which would in turn offer more effective passporting rights across the EU. Would this sort of setup help overcome the objection some market actors have to single supervision? What do you think?
Thank you. Well, I mean, I think something, and if I didn't say this strongly enough earlier on, I should have, that the amount of comment and reports that we've had to try and activate investment is actually really positive, and we should be making sure that we capture that momentum. I do think in all of the reports that we've seen, it's interesting, the perspective of the owners of the capital are less prominent, which I would like to see that happening more. And also in all of the various reports, whether it be the Noye report or others, we variously have integrated supervision, comprehensive oversight powers, convergence and efficiency of supervision, supervisory convergence, single supervisor model, larger supervisory mandate. We've got about 20 different terms. And I think it's really about trying to figure out which ones are the best ones. I would say that when we look at it, and I'll comment specifically on Noye, that line, that straight line between supervision and the contention that it will deliver capital markets is very difficult for us to see that line being drawn. I would say positively in terms of the report, which was very detailed. I think it comments on supervisory colleges, which have been effective. We've seen supervisory coordination network, I think, has been very, very good. And it should reflect really the reality that we have, that already activities have been distributed around the union for very good reason in many cases. I think Noye also points out the ability to have forbearance provisions because the implementation path is important. So whether that be no action letters or some of the sequencing points that I made. The point on interoperability and reporting, I think, is very important. That is a key enabler to build trust, to build understanding, to build transparency. So I would definitely see that the reporting obligations increasing, and we've seen obviously that change more recently under AIFMD and UCITS. I think that will help no end with where we're going. Where I would challenge, though, and I would challenge the fact that it is suggesting in the report that national approaches are a consequence of supervision. I do not believe that's the case. So, for example, if one was to say that in the absence of supervision, that, you know, in the absence of national supervision, if you had central supervision, that it would ease the problems. If I'm setting up a private equity fund to invest in European SMEs and I want to distribute it, I will come across, if I want to distribute it to the insurance sector in one particular country, if I want to get tax benefits in another country, I will run into difficulties. They have nothing got to do with supervision. They actually have to do with underlying structure. So I think it's important that we're clear about where the impediments are and where the impediments aren't. Because clearly you still have to comply with all of the national regulation. I think that there was this point about opt-ins and as being kind of effective for supervision. So if we're saying that if you have an opt-in to central supervision, that's going to be better than existing passports, isn't that more a comment about the operation of the existing passports rather than creating potentially a two-tier system? And that is, I think, a risk here. Because ultimately what we're looking for is a greater harmonization right across the board. The objections finally, and I'll try and be brief, that you say that come from market participants, they're not necessarily principled just because we're talking about single supervision. So their objectives, excuse me, and this happens whether we're talking in Ireland or I talk to my colleagues around Europe, they want consistent and converged rules. There isn't the same equivalent support for single supervision because we're in an environment, as was discussed at the very start of the panel today. We've got higher inflation. It's harder to generate risk-adjusted returns net of fees. So therefore, if one adds on potentially another level of costs, another level of reporting, what are you doing to diminish those? And I would say finally that, you know, we'll talk a little bit more about comparisons with single supervisory mechanism, and I know we've had comments about the SEC. I think we got to be careful that we're not attributing a benefit from one model created for one purpose to another set of circumstances. That I think is worth discussing a bit more.
Great. So let's move to Alexandra. So Alexandra, focusing on the single supervision of the largest wholesale actor makes sense from a financial stability perspective and could be more politically feasible. But it could leave entities that cater for retail investor, for which investor protection is a key supervisory concern, within the remit of national supervisors. Is this something you are concerned about, and how could this be addressed?
Thank you. And thank you also for many good comments done by previous speakers, and especially to Pat for, again, underlining that the discussion should be a bit more revolving about around the owners of capital, also the access to good products. And this is also very important. We see the point. So Better Finance really tries to be pragmatic. We had, we think, some good proposals how to improve the access to good products. As we have seen in the recent discussions on the EU level, there was not enough political willingness, there was not enough courage to follow up on that. When it comes to the focus on the wholesale, we do see the point. So as also Verena said, the focus on significant pan-European business, as also Nicolas mentioned, wholesale actors, of course, have significant cross-border operations and are more likely to pose systemic risks. So having a dedicated supervisory focus to ensure that those large systemically important institutions are monitored rigorously, we do see the point. We also see the point of the subsidiarity principle. And but saying that, we do also see and we do hear some concerns that would be entailed with this approach. And so in some discussions that we had also with different stakeholders, we did hear concerns about the neglect of retail investors. So focus on the wholesale actors leading to insufficient retail attention to retail investor protection. The dual supervisory framework, of course, could create some further inconsistencies and gaps that we were saying at the beginning of our discussions we would like to address with the single supervisory body. Investor confidence was one of the points that was raised. The concern that the retail investors' confidence could be undermined with the focus of single supervisory body only on the wholesale issues. Well, I've discussed also resource allocation, so the concern that in the focus of the single supervisory body on the wholesale, the resources could be diverted then from the national supervisory authorities. I'm not sure if I exactly see this, but in this setup, I would say that also drawing the inspiration, in fact, from the competition policy and how this system works, maybe would not be bad. Because in fact, there you do have one central, very strong body, and you have many authorities in the member states. And it is fact that 90% of the decisions there are taken by the national competent authorities. But let's not forget that there was also a huge effort in this area of the European policy to have those national competent authorities on the same level in terms of supervisory toolbox, enforcement, resources, independence issues. So there's whole directive focus and really directed at making them equally, I would say, efficient and effective.
Thank you. Thank you. Then let's move to this third round of questions. One question for each panelist, and we will focus on supervisory architecture and governance. There are different approaches that could be taken to achieve single supervision, both in terms of the respective power and responsibility of national and EU supervisor, and in terms of the governance of the EU supervisor itself. So let's start from Pat again. In your view, Pat, how could the single supervision be set up in such a way that it caters for the specific needs of each national market? Can there be fully harmonized supervisory practices without a single supervisor? Please, Pat, 3 minutes.
Thank you. So listen, I think given my comments earlier on, I'll probably focus a bit more on harmonization. As I said, I came from Poland yesterday, and they're at a different stage of their journey. But I think it's important when we're putting this together to realize that we have to make sure we bring the citizens of the Union along. And if we don't, there will be both economic and political costs that down the line, particularly because we're talking about their money funding the collective issues that we need to face. I would be of a view that harmonizing practices is definitely achievable. I think ESMA have demonstrated that. I think, we've seen 29 peer reviews. So there is definitely an ability to do that. I would re-echo the point about data and using that to support governance. I think we probably tend to forget as well that the system really goes far beyond what we see in other elements of the single market. And I think to the comparisons about the single supervisory mechanism, and let me preface this by saying I'm not an expert in banking, but the single supervisory mechanism was created obviously to make sure that systemic risks were addressed. I think it is clearly open to question whether the single supervisory mechanism and a single regulator has created greater competition in the market and actually has created great cross-border. So if we are using that as a rationale for creating a single supervisor in the security side, I think that we probably need to see a little bit more evidence of that actually happening. And I think from the SEC has been mentioned elsewhere. So the question I would ask is, do we have greater retail participation in the United States because the SEC was created in 1934, or because the 401k was created, which has given rise to retail participation? I think the answer is the latter. I haven't done the numbers, but I'd be pretty confident. And I think ultimately, when we come down to questions of governance or mandate, these all become quite political questions. I do think that if there was one piece that it would exist in the mandate of ESMA and all regulators, is that it is financial inclusion, and that there, as well as having an obligation to make sure people don't suffer by being missold something, or that there's greenwashing, that there equally is a compulsion both in the design and the delivery of regulation that people must engage with the financial services community, because the risks to them if they don't are potentially greater than the risks if they're missold something. That, I think, would be an important part of mandate. Thank you.
Yeah, that's an interesting perspective. So let's move to Alexander again. There has been concern that ESMA governance make it insufficiently independent from national supervisor, and the Commission has tried to address this in the past unsuccessfully. What change to ESMA governance do you think would allow it to perform more efficiently? 3 minutes to answer to $1 million question.
Yes, thank you. Just a very key to answer the very good, interesting comment on the financial inclusion. We would still think that to make the CMU and investing in capital markets and in general in the EU more relevant to consumers, access to independent good advice would be even more important, but it's of course connected to financial inclusion. Yes, indeed, we do have, of course, concerns over ESMA governance. We do appreciate and we do see a lot of good work being done by ESMA and trying to also improve the supervisory convergence and the recent trying to expand the role of the forum of the senior supervisors with the heads of enforcement being there. In terms of the governance, of course, the problematic and inherently problematic issue with ESMA's governance is supervising the entities that are part of its supervisory board. So, of course, this raises a lot of concerns and it raises a lot of problems. One of them is the influence of national interests on the final decision-making in ESMA. There is a question, of course, of independence from the national interest during the decision-making process in ESMA. And also referring partially to what also Stefan said, different entities, financial entities in the European Union, they are not evenly, their activity is not evenly distributed in the member states. So, of course, quite often it happens, as I can imagine, that the entities, the national supervisory authorities that actually are not really experienced, do not see certain activities, are in the end influential and taking part in the decision-making process concerning the entities that are really problematic from the also retail investor point of view. We also see the problem of such a big supervisory board having influence of the pace of the decision-making of ESMA and possibly also slowing it down. And what could be the solution? So we have already advocated for that during the ESAS reform. We would like to see more independent members of the supervisory of ESMA. And here I also wanted to say actually EIOPA. I mean, I know we are discussing right now ESMA, but from the retail investment point of view and the fact that EIOPA is supervising such a huge amount of retail investment product, we would like to see the same governance, improved structure in EIOPA as well, and also strengthening the management board. We would see this as a very good solution forward. We could also maybe look at EMLA, what also was referred already to Nicolas, because it seems to be working quite well, and see how much and how far it could be transferable to ESMA. Long term, and this is again something that Better Finance has been advocating for already during the ESAS reform, would be to have a Twin Peaks model, because we really think that having a Twin Peaks supervisory architecture for the EU financial system would actually take really into account the interest of the retail investors, and it would improve their situation in comparison to what we have right now.
Stefan, this is for you. One potential concern of market participants that they could have with the single supervision is having to interact with and pay fees to both national and the EU supervisor, which could actually increase the compliance cost and decrease efficiency. Are you worried about this, and what would be the most efficient setup from your perspective?
Well, I'm always worried about cost, about taxes, but you know, the rule of law has no price, but it has a cost. You have to pay people to do the job and to implement supervision. And for sure, the end game is some form of coexistence of a federal supervisor and local supervisors. And for sure, as in the case of the banking supervision, it will take time to clean up the local monetary policy museums and to find some specific relevance. I said earlier that in the case of market supervision, it will be easier. It will be easier, and it will be because there is an obvious role for local supervision when it comes to issuers. But there will be a moment of double cost that's unavoidable. Also, building a federal agency that will have the power and the bandwidth and the skills and the reactivity of the SEC will mean more work for us, but will mean also probably, I wouldn't say better management, but a different management, because the core mandate will move from contributing to the production of regulation and drafting towards active supervision of situations. So that's unavoidable. I think what is important, and I want to conclude with that, is that we focus on two things: single rule book. One of the best output of the previous cycle is the Listing Act, with the decision to have at last a sort of European S1, a single prospectus, and many of us are working hard to make sure that this single prospectus becomes as close as possible to an American S1, because that will change the life of the planet in terms of investing in European companies, ACM teams, asset managers, everyone. And the second thing is to make sure that whatever we do, again, is done without forgetting that the core solution is to make sure that we fix equity investments in Europe. Everyone complains about the fact that there is only 3% participation of retail investors in Europe versus 30% in the US. The explanation has nothing to do with whether or not we have a capital market union. The explanation is because in the US, when you are young, if you want to have some income, when you are old, you have to buy shares. Whereas in Europe, when you are young and you want to have some income when you get old, you just have to hope that people around you will continue to pay taxes and social contributions. So that's the explanation between 3% and 30%. The same for asset managers with prudential risk. I do believe, I'm going to see Christine Lagarde later today, I will tell her the problem of Europe is not that there is too much risk in portfolios, as there was the perception in the early 2000s and mid-2000s. The problem of Europe is that there is not enough risk in portfolios. We have created asset management rules where people cannot invest in risk because everything has to be liquid and safe, and you have to have a life jacket, an umbrella, a belt, suspender, condoms, everything. So otherwise you cannot invest. The problem is that the explanation to the gap in the risk financing, in innovation financing between the US and Europe is precisely because we need to switch the concern from there is too much risk. There was too much risk. That was the macro risk. But today there is not enough risk. And therefore, prudential ratios have to change. It's a big contracyclic because I'm saying that whereas at the moment where solvency is going to be published or is published in the Gazette, but the reality is that it's a contra-cyclical measure. So making equity great again means that at the national level, at the multilateral level, we need to switch completely the rivers of investment, of savings that are today distracted to public debt and to export of investment into non-European asset managers. Otherwise, everything we discuss in this building will be like discussing the sex of the angels while the Ottoman are capturing the city of Constantinople.
Thank you. Thank you. This is interesting. And maybe but for another time, we should discuss whether we have a preference for less risky investment or if there is something else. But this is for possibly another time. So let me move to Nicolas again. So Nicolas, you argued that the ESMA direct supervision should be decentralized through regional offices, but without involving staff from national authorities. Do you think this is politically feasible and realistic? And why would this work better than involving the national authorities?
Thank you. To clarify, I didn't say this shouldn't involve staff from national authorities in the sense that I advocated ESMA creating local officers. It would be perfectly fine, I think, for those local officers to poach or employ staff which currently works for national authorities. Look, this is, I think, a leitmotif of this debate is this is different from banking supervision. And again, it's appropriate that we have the debate in this building. But it is different at a fundamental level, as Alexandra and Stefan particularly have emphasized, and Pat as well. We're talking about protecting investors first. This is a conduct of business supervisory challenge, mostly. There are elements of financial stability, but they're not front and center. And that's different from a prudential approach. So there are many reasons why we really cannot copy the design of the SSM. And I very much emphasize with what Alexandra mentioned, what we are doing is not creating Twin Peaks in infrastructure, but the Twin Peaks architecture, the model should be the kind of long-term horizon that we aspire to reach one day. So why is this idea of local offices of ESMA attractive? For reasons that are both of policy and politics. Let me take them in that order. The policy rationale for having local offices is the point I mentioned earlier. You need connectivity with market participants, including those which are not in Paris. And if your only connectivity is with the Paris-located market participants, that is competitive distortion, so it's a bad idea. And again, we won't have the same supervisory model as we have here for significant institutions. Maybe you can create something like a joint supervisory team for Euronext that maybe would make sense, but not for, say, rating agencies or trade repositories. Moving from the current exclusive competence of ESMA to a joint supervisory team framework would make absolutely no sense. And it's very clear that there will be a number of segments like that. So that's a policy reason. You want the connectivity with market participants. Of course, the mission should be, at least in the first phase, focused on wholesale, not retail, but still you need to understand the local laws, the local language, etc. The second reason, which is political more than policy, is that to state the obvious, and that was implicit in your question, there is fierce opposition to supervisory integration from NCAs and also from a number of market participants, as we have seen. But it's going to require a different political compromise from the one that was achieved with the creation of European banking supervision, or for that matter, with European monetary union. So you will need a political compromise at the high level where member states get something, but it won't be the kind of designs that we have with national central banks or in banking supervision with NCAs. So it has to be something different. I would argue that given the nature of market supervision, it cannot be a compromise in which NCAs get something, but it can be a compromise where member states get something. So this is a political reasoning. I'm outside of my area of expertise, but I think that works. So basically what you want is to create buy-in from the member states, if not from the NCAs. The suggested design would be that the ESMA officers would both provide the local connectivity and could have specialization. So for example, you could say, you know, accounting standards is in, I don't know, I'm putting random places, in Amsterdam. Market infrastructure is in Frankfurt. You know, this or that thing is in Paris. Paris anyway is the seat of the organization. You know, something with fund management, absolutely in Ireland because they're so good at it. You know, that kind of things. Again, it doesn't have to be this, but the idea is that you can create that basis for political consensus, which is difficult to achieve, in a framework which is generally more centralized than what we have for European banking supervision because of the nature of what we're talking about. You mentioned Benoît Cœuré, his mention of competition authorities. I'm already past my time, so I won't expand on that. I will only mention that most, I believe all, competition authority, national competition authorities in the European Union were created after the creation of the coal and steel community and even after the Treaty of Rome. So they were created in an environment where they would be part of European frameworks. That's obviously not the case for market supervisors. Thank you.
Right. So let's go to Verena. So Verena, echoing this idea that ESMA should become more decentralized, as you know, Nicolas just said. Some see the risk that Paris could become the EU leading financial center as a political obstacle to strengthen the role of ESMA, and argue that regulation and supervision should be separated, similarly to the setup in banking supervision. Does strengthening ESMA really mean strengthening Paris as a financial center? And what do you think of the idea of separating regulation at ESMA from supervision in another entity?
Thank you. Certainly, let me first, before I answer your two specific questions, take one step back because I just want to be clear. We're talking here in the panel today a lot about the supervision, centralization of supervision, but I fully agree that we're not going to build an effective capital market for Europe just by focusing on that. It's one of the aspects we need to look at, but it clearly can't be the only one. So just to make sure that we are not forgetting that. On your questions, I think I would very strongly put that strengthening ESMA does not mean strengthening Paris. Strengthening ESMA means strengthening the European Union. ESMA happens to be based in Paris, but ESMA is an EU authority, and we have the interest of Europe in our heart. I might buy my croissant in the local boulangerie in Paris, but when I move into the ESMA offices, I'm a European. I'm not there to strengthen any particular center. I'm there to make sure that we actually have an effective European capital market. And I want to be please clear that that will drive every one of us in ESMA and has always driven. It's one of our core values is to be European. So no bias, no particular reference. What I think we also need to have, and I fully agree with Nicolas, is the ability to really understand the markets in different parts of Europe, because they are different. Capital markets have developed very different in different parts of the European Union. So we need to have that understanding. Whether we need to be decentralized for that, I'm not quite sure. We're quite a small organization, actually of 350 people. I'm not sure you want to split us around 27 different offices. I don't think that's necessarily the most efficient way to go about it, but that we can discuss for a future debate. So capital markets has to work for everyone. It has to be genuinely European. Then moving to the kind of collaboration with the NCAs. I think whatever we do and however we set up the central supervisory function, we need to work with the national competent authorities. In many cases, they have the expertise on the ground. We need to make sure that we use that expertise, that we can benefit from that. We don't want to just duplicate. We want to actually make it work effectively as a whole and make sure that we actually have the efficient use of all of our experience. And then part of that, I think, also goes to the governance point. Actually, if I think about how ESMA works at the moment, I actually have very heated and intense debates on certain things when it comes particularly to regulation and to guidance. When it comes to our direct supervision mandates, actually the trust of the whole board in the ESMA ability to do that and the ESMA staff is huge. So it's actually much less controversial, much less debated, and people genuinely take their national hat off when it comes to the supervisory task. Finally, on regulation versus supervision, I personally don't believe it is a good idea to start splitting that. And again, I think you need to look at capital markets with its very different aspects differently from banking. In the capital markets, you clearly have very diverse specialization. You have people who supervise issuers, who look at prospectuses. You have people who are experts in fund management. You have people who know about clearing and settlement, just to give a few examples. If you pull apart the few people and experts that you have into supervisors and policymakers, you really lose something because you need the virtuous circle of understanding regulation to be a good supervisor, and you need to be having the supervisory expertise to actually do good policymaking.
Thanks. Thanks a lot. You have been very disciplined, so we have some time for question from the audience from here and from remote. Before giving the floor to the colleague that just raised his hand, please, I want to make just what I learned today is that we are not just bank center in the intermediation, but we have too much bank in our mind, if I understand correctly, right? We look everything through the model that the way we intermediate savings is also shaping the way we think about supervision. So we should move out of this mental scheme. Please, can you introduce yourself and
Giovanni Bassani from the ECB. A more general question on the institutional framework. I'm just asking because this morning the European Court of Justice issued a decision in which, I still have to read it accurately, but in which basically said that the Single Resolution Board is not an autonomous and independent authority, but basically all the resolution decision needs to be, the real decision is coming from the European Commission. Of course, it was going back to the old Meroni doctrine. So I was wondering, it seems, again, I have to read this judgment in more depth, but it seems again that these all debate agency institutions, not that the agencies are once again put back to a sort of ancillary role. I'm maybe exaggerating. And so I was thinking what Nicolas was saying, that there is already a model like AMLA. Apparently, if they need to supervise the markets, it takes a lot of discretionary decision, not like banking supervision, but I would say similar. It seems with the institutional structure and the institutional European framework, that's not possible. So either you are again in the dilemma, you change the treaty, you create a real European institution to do that, or a European agency doesn't seem to be fit for purpose.
I haven't read the ruling either, so I remember ESMA short selling, which was a ruling of, I guess, the same court. What kind of SRB decision was the matter of the ruling? Was that a resolution decision, or, for example, a resolution in Banco Popular? That's interesting. Okay. Well, to be further explored. If you had asked a question yesterday, I would have said my impression of the jurisprudence of the ECJ is that for the kind of things we're talking about in terms of supervision, there is actually no doubt that Meroni gives the leeway. But again, thanks for mentioning this new data point, and we'll look at it. Please.
So if we actually did have a bit of a debate in this in the board task force, which looked at what we wanted to put forward as ESMA on the capital markets. And one of the recommendations you will see is on the regulatory framework. And actually within that, one of the things we were very conscious of is that indeed sometimes the current legal regime is very restricted on the judgmental possibilities that you have and is quite going back to a world like Meroni, which really is not the world that we currently live in and where we have to make decisions, in which we have to make decisions. So I think it is something that is a real challenge in the agency setup. So I haven't read the judgment either, but I will read it with great interest because it's certainly, I think, one of the constraints that is there, and that at least some greater flexibility in interpreting the various Meroni rules, I think, would be valid to have a look at. Thank you.
Thanks. I had a look at the question online, but it seems to me that, you know, the discussion has provided plenty of answer to the question that I am reading. So in the, you know, to be on time, I just would close here. And, you know, my note says, this conclude this session, and I'm sure we will continue to discuss these fascinating topics and complex topics for the years to come. I hope we will do something shorter than years to come. So, but you know, one fundamental ingredient seems to be that regardless the solution and the answer we found to this, the many questions that have been raised today, the starting point is the same one, that we need to find the political willingness to move ahead with this issue. So the momentum we have been seeing in the past months, we should keep it and make sure that we can carry forward this momentum in the next legislative cycle. Thank you all for intervening, and thanks to the panelists, and we will hear in a second from the ECB Vice President Luis de Guindos. We will provide the closing speech. Thank you very much. So let me first welcome Luis de Guindos, the Vice President of the ECB. We're just 1 minute ahead of time. There are people connecting online. I hope they don't connect only because you're going to start your speech. But let me fill the 1 minute gap by simply saying that
As some people in the room or online may remember, I did present you with mostly technical, highly boring, complex charts earlier on, analytical stuff in a nutshell. And I said we reserve the details on the policy aspects for the Vice President of the ECB. His speech later today would give you the relevant perspective from the policymaker, decision maker level, and that's now the time for it. So you have the floor.
Thank you very much, Jerome. Good afternoon to everyone. Let's continue with this fascinating, as Piero has said, topic. And I will start, if I may, stating that it's a real pleasure to address you once again at this annual joint conference on European financial integration. Over the years, this platform has become an important forum for discussing the key issues shaping the financial landscape of the Union. The discussions and analysis we heard in today's session provide valuable perspectives on how we can foster financial integration. The conference is also very timely, coming just before a new European Commission will have to shape the policy agenda for the coming years. Financial integration and financial stability are key to ensuring a resilient and prosperous future for Europe. Despite the resilience shown during the recent unprecedented times, marked by significant global geopolitical and economic shocks, progress towards greater financial integration in the euro area has been disappointing overall. Over the past 2 years, price and quantity-based measures of financial integration have declined substantially. In fact, we are back to the levels seen at the start of the monetary union. And this is despite the significant legislative efforts made over the past decade. Cross-border financial market activities and risk sharing have not recorded any growth. Financial integration has shown little progress in terms of cross-border bank lending and equity markets. Yet, these markets are key to helping small and medium-sized enterprises, the backbone of the euro area economy, overcome their financing challenges. They are also a critical source of risk capital for innovative and high-growth companies, particularly in sectors such as technology, biotech, and renewable energy. Cross-border lending can generate important benefits, especially in relation to private sector risk sharing across countries. Banks can reduce the concentration and home bias of their exposures, while borrowers can broaden their access to financing and strengthen funding resilience when the domestic market is under stress. Yet, the European banking sector is still fragmented. Over the past decade, little progress has been made in integrating banking groups across borders. And when consolidation in the banking sector does occur, it is often at the national level. Despite the existence of a European supervisory and resolution framework, a number of prudential and resolution requirements, such as capital, liquidity, and loss-absorbing requirements, are still national in nature. This is a major obstacle to integration. To foster cross-border banking, we should make it easier for banks to operate as truly integrated groups within the banking union. For this to happen, there needs to be the same possibilities for pooling capital and liquidity across legal entities located in different member states, as there are for banking groups operating within a single member state. We should also take a more harmonized approach and a banking union perspective when setting minimum standards for capital buffers. In times of crisis, further harmonizing bank crisis management across the banking union will enhance the level playing field in Europe. The stakeholders need to be sure, if a bank fails, there will be a similar outcome regardless of where in Europe the bank is domiciled. The resolution framework is a key part of this effort, and the ongoing reform of the crisis management and deposit insurance framework aims to broaden the application of a harmonized resolution framework beyond significant banks. Yet, many bank failures will still be managed under national insolvency regimes, so further convergence on there is also needed. When a bank is wound up under a national insolvency framework, the Deposit Guarantee Scheme plays a vital role in safeguarding depositors' access to their accounts. For now, these deposit guarantee schemes are also national, which can lead to the perception that a euro deposited in one member state is safer than in another. Finally, making progress on introducing a European deposit insurance scheme, EDIS, should be a priority for the next legislative term. EDIS could bring us closer to the vision of a true single market for banking in Europe. For the ECB's Governing Council, a more integrated EU banking market is a key reason to develop a capital market union and establish a single market for capital in the EU. Previous editions of the report presented today have illustrated the need to further integrate financial markets to enhance the euro area economy's resilience through private risk sharing and to strengthen the international role of our common currency. It has become increasingly clear that European capital markets are instrumental in the pursuit and financing of the EU's strategic goals. We need massive investment to drive the green and digital transitions, and we must boost the EU's productivity and competitiveness. A starting point for the discussion is often the relative success of US capital markets, which can be attributed to several factors. A significant one is the global role of the dollar in international finance. A common set of laws and regulation on trading financial assets ensures the coherence of US capital markets. This is supported by the market of US Treasuries, the largest and most liquid asset in the world. And a consolidated trading and post-trading landscape also encourages investor participation in the market. These elements contribute to the pivotal role that US capital markets play in financing innovation firms domestically and internationally. Drawing on these initiatives to promote pan-EU capital markets should first focus on enhancing both the supply and demand for capital market funding. I see several concrete action points. The first is to channel Europe's saving towards EU equity and bond market by developing EU-wide saving products subject to a common framework and a harmonized tax incentives. Second, we need to develop equity markets to make them more attractive for issuers and investors. Risk capital markets are particularly important for fostering the innovation necessary for the green and digital transition. Third, we must mobilize securitization markets for capital market union. Comparing the Union and the US markets highlights the role that US government-sponsored enterprises play in fostering standardization and market depth in the US. Nevertheless, we must remember that simply increasing finance is not enough to achieve economic growth. Funding needs to be used in the most effective way possible. This is why we also need policies that support economic restructuring and projects that provide opportunities for more productive funding. Finally, the push for capital market union or a savings and investment union should go hand in hand with renewed efforts to remove barriers within the single market. Further harmonization of corporate insolvency rules, accounting frameworks, and securities law is needed to establish a single capital market with scale and depth. Let me conclude. Financial integration has supported the euro area's resilience in the face of significant geopolitical risks, economic shocks, and unprecedented high levels of inflation. This is reassuring. However, the decline in certain measures and the sluggish progress towards greater integration is really disappointing. Urgent action is therefore needed to increase investment in the EU and establish clear priorities to address the challenges ahead. Advancing capital market union should be a critical political project for the new European Commission. It should go hand in hand with strengthening the resilience of the non-bank financial sector as it consolidates its importance in financing the EU's real economy. At the same time, Europe remains primarily bank-based, and completing the banking union remains a priority. A single capital market needs to come in addition to, and not instead of, a complete banking union. Setting up EDIS should be high on the agenda in the next EU legislative term. It is essential for depositor confidence and for ensuring a level playing field for banks. Both the capital markets unions and the banking union should be viewed within the broader context of the European project. Enrico Letta's recent report rightly considers the single market as central to financing strategic goals, competitiveness, and the future of the Union. Removing existing barriers within the market for goods and services and advancing in the three strategic sectors that were previously excluded from the single market, namely financial services, energy, and telecommunications, will allow us to benefit from the full scale of the market. The single market for goods and services is essential to attract investment, make our economic and monetary union more attractive, and support the EU's role as a global player on the international stage. At the same time, stated procedures must guarantee a level playing field and be compatible with the single market. Lastly, a permanent EU central fiscal capacity remains essential to the European project. It could enable us to tackle geopolitical and economic challenges more effectively. And by supporting investment in strategically important areas, generating economies of scale, and raising productivity across the bloc, it could help to improve the welfare of European citizens while further enhancing financial integration in the European Union. Thank you very much.
Thank you, Mr. Vice President. I wonder, we still have time in the agenda for some questions, if you are willing to answer questions. So questions from the room, and we should have a mic. There are any question? It's been a long day. I think you delivered on more details on the policy aspects, and you also broadened the scope beyond what much of the discussion was about, apart from a few questions, namely CMU, but you also went beyond that. And maybe you've been so complete that we have no further feedback.
Perhaps, Jerome, one comment from my side. I think that the main message, well, the outcomes, I suppose that you have analyzed, the different indexes that you have available. And the outcome is a little bit disappointed in terms of financial integration. That's the main conclusion of the different numbers that for sure you have been analyzing and the outcome of the report. But I think that it's very important to ask why. And I think that sometimes, we are focusing on finance and capital market union and the banking union, and I think that they are key aspects. But I think that perhaps, the lack of financial integration at the end of the day responds to the real economy. And why don't we don't have, projects and European projects that are attractive enough? And why, the fragmentation that sometimes we see in the single market is not reflected, is not mirrored in terms of finance? I think that this is a big question. Because for sure that in the future, we will continue having some data, we will have up and downs in terms of financial integration. But I think that in order to have, a real fully integrated financial market in Europe, have a real capital market union, I think that we have to make progress in several fronts.
Thank you very much for this compliment and for the speech, Mr. Vice President. So this is now the time for concluding the conference. I won't do any wrap-up this time. We have a rich to-do list on a tentative basis. Let me just end up with two small additions. The sort of idiomatic approach, like low-hanging fruits, glass half empty, half full. And I would prefer to repeat what I heard from the Scots supporters yesterday in the tram. No CMU, no party. Having said that, have a safe trip home.